Hello everyone, welcome to JK Shah classes. Very good morning to all of you. I am Professor Chirag Goyal. We have gathered today to discuss the revisionary test paper for the subject direct tax for the attempt May 2024. Now friends, as you would have seen that ICAI has uploaded the revisionary test paper for the paper 3 taxation on its BOS knowledge portal, which I have downloaded and it is open right now in front of you. Before we start discussing the question answers, just a quick discussion about the updates or amendments which are applicable for May 2024 attempt. As you people must be aware that for May 2024 attempt, the financial year which is applicable is 2023-24, that is the previous year, 2023-24, for which the assessment year is 2024-25. The Finance Act which is applicable for 2023-24 is Finance Act 2023. So friends, all the amendments which had come by the virtue of Finance Act 2023, they have already been incorporated in your study material as well as the JKSC classwork textbook. However, any circulars or notifications which were issued up to 31st October 2023, even they are applicable for May 2024 attempt. As far as these circulars and notifications are concerned, ICAI has issued a separate booklet called as Statutory Update, which is again available on the ICAI BOS knowledge portal. So whatever you have to study for May 2024, that includes your JKSC classwork textbook, all the classwork problems, homework problems, along with the statutory update PDF and the notes which would have been given to you during the lectures. Now let us start, friends, discussing the question answers of this revisionary test paper. First question, which is a case scenario based question wherein they have given you a case study and then at the end there are 5 MCQ based questions. First of all, I will give you a small gist about which all chapters and provisions have got covered in this case study once we first read the complete question. So let us first read the complete question. Mr. Akash, aged 47 years, is a CEO of BAC Enterprises Private Limited. Friends, whenever you read any question in direct tax, be alert for each and every information. Like when you read the age of the assessee, you must get alert that he is not a senior citizen, so that if at all they ask you tax calculation, you will not apply those increased basic exemption limits which are applicable to a resident senior citizen and resident super senior citizen under the optional tax regime. During the previous year 23-24, he has earned the following incomes. There is a salary of 45 lakhs. Friends, whenever question says that earned the following income and they give you the figures, these are always gross figures. So when they say salary of 45 lakhs, they are talking about gross salary of 45 lakhs. However, if they would have written the wordings like this, he has the following income, salary 45 lakhs computed, then we would have considered it to be after the standard deduction and after all the deductions as applicable. But since they are saying he has earned the following incomes, it means it is gross. Long-term capital gains on sale of listed equity shares on which securities transaction tax has been paid, amounting to 6,54,000. So long-term capital gain on sale of listed equity shares, they go under section 112A of Income Tax Act. Dividend of 12 lakh from shares of Indian companies. Friends, dividend is always an income from other source. Interest on saving bank account with the State Bank of India of 16,000. So even this is an income from other source. However, under optional regime, assessee will be entitled for 80 TTA deduction. Interest on fixed deposit with Bank of Baroda of 45,000. Even this is an income from other source. He will not be entitled for 80 TTB because he is not a senior citizen. Mr. Akash has made the following payments towards the medical insurance premium. So, health insurance premium covered under 80D. For health policies taken for his family members, medical premium for his spouse, aged 43 years, so spouse covered under self and family, 13,500 by check. If you recollect, 80D says payments should be done other than cash. However, preventive health checkup paid in cash is tolerated, that is accepted. Medical premium for his mother, aged 65 years, 26,670 by check. So, it will get covered under parents. Again, the payment is done by check. Preventive health checkup of 5,500 each for his wife goes under self and family, and mother goes under parents in cash. Mr. Akash has also incurred medical expenses by credit card. Credit card is also permitted. It should not be in cash. Other than cash, everything is permitted. Of 17,000 for the treatment of his mother and of 27,000 for his father, who is 67 years old. He has multiple life insurance policies. The details of such policies are given here under. They are giving you 5 insurance policies of Mr. Akash, wherein they are giving you the date of issue. They are giving you the annual premiums, which are excluding GST figures. Then they are giving you the GST figures on those premiums. They are giving you the total premium. Date of maturity is given. Consideration received on maturity, including bonus, is given. And sum assured is given. And now they are asking you 5 different MCQ based questions. On the basis of the facts given above, choose the most appropriate answer to question number 5 to question number 1 to question number 5 below, based on the provisions of Income Tax Act. So friends, first of all, in this question, they have given you certain incomes of Mr. Akash. Precisely, there's an income from salary. Then there is a long-term capital gain. So income from capital gains. Then there are certain income from other sources, dividend and those two interest. The total of these 3 will give you gross total income, from which there will be deductions under chapter 6A under optional tax regime. And if we have to calculate the income as per default tax regime, that is 115 BAC, then the deductions will not be allowed. Secondly, they have asked you another leg of this question, which is based on that amendment which has come in section 10 clause 10D with regards to maturities of life insurance policies. Since the first and the second question of MCQ of this case study, they are based on that amendment of life insurance policy. So let us first start discussing this part, because actually these 2 parts are separate parts of this question, wherein this life insurance policy part is testing you on that amendment. So let me first brief you about what was that amendment. But before we discuss the amendment, let me tell you the earlier provision. Friends, you would have read two sections, 80C and section 10 clause 10D. In section 80C and 10 clause 10D, in both the sections, there was some mention about life insurance policies. Whenever assessee takes a life insurance policy for which he is paying premium, either the policy is taken for self, or it is taken for spouse, or it is taken for children. In such a case, the year in which he is paying the premium, he can take the deduction under section 80C. However, friends, section 80C says if the policy is taken up to 31st March 2012, then the annual premium of such policy should not exceed 20% of sum assured. So it should be less than equal to 20% of sum assured. Like if a policy is taken in the year 2007 and let's say the sum assured is 5 lakh rupees. Sum assured, also referred to as capital assured at times, or sometimes they also call it as assured value. Friends, sum assured is the minimum amount which is guaranteed by the insurance company which you will receive towards that policy. So if the sum assured is 5 lakh of this policy, then since 20% of this is 1 lakh, if I am paying an annual premium of 75,000 for this policy, then I can say it is less than equal to 20% of sum assured. However, if I am paying 1,25,000 annual premium of this policy, then that premium is more than 20% of the sum assured. Sir, what happens if the premium is more than 20% of sum assured? In such cases, there are two consequences. First, your 80C deduction gets restricted. Like if the premium is 1,25,000 per annum, sir, your 80C will get restricted to maximum 20% of sum assured. So that is maximum 1 lakh. This consequence is still fine, but the another consequence is serious, wherein if your premium would have been less than equal to 20% of sum assured, then sir, whatever maturity proceeds you get from this policy, whatever money you get from this policy, that becomes fully exempt if the premium is less than equal to 20% of sum assured. But if the premium is greater than 20% of sum assured, then sir, the maturity proceeds or whatever sum of money you receive from this policy in future, sir, that maturity becomes taxable. Similarly, if the policy is taken between 1st April 2012 to 31st March 2013, then the premium percentage is directly reduced to half, 10%. 10% of sum assured. Your annual premium should not exceed more than 10% of sum assured. It should be less than equal to 10% of sum assured. So if a policy is taken in, let's say, May 2012, since it is between 1st April 2012 to 31st March 2012, if the sum assured of the policy is 5 lakh rupees, now in such case, sir, 10% of this 5 lakh will become 50,000. So if your annual premium is, let's say, 40,000 per annum, I am paying the annual premium of 40,000, then it is below 10%. So sir, deduction will be allowed under 80C, entire 40. Even the maturity proceeds of this life insurance policy will be fully exempt under section 1010D. However, if the annual premium which I am paying is, let's say, 60,000, now since that 60,000 is more than 10% of sum assured, sir, first consequence will be your ATC will get restricted to the extent of 10% of sum assured, maximum 10%, that is 50,000. And second biggest consequence will be you will not get 1010D exemption, the maturity proceeds will become taxable. Friends, when the government reduced the percentage to directly 10% in 2012, they realized that for one category of person, or rather we must say two category of persons, 10% would be a lesser limit. So let us enhance it. So after 1st April 2013, if the policies are taken, they again increased the percentage to 15% of sum assured, but only for two category of people, as I said. One, person suffering from ATU disability, and second, person suffering from specified diseases mentioned under 80DD. B. 80DD. So basically rule 11DD specified diseases, those cancer, AIDS, etc. So understand friends, this increment of percentage was only for these two category of people. For all the other peoples, like people who are not even disabled and people who are not suffering from any of those diseases, for them the percentage is still 10%. So if a non-disabled person has taken a life insurance policy, or a life insurance policy has been taken for a non-disabled person, in such case the premium percentage is still less than equal to 10%. So that same example, if the policy is 5 lakh, premium should be less than equal to 50,000. If it is more than 50,000, two consequence, ATC will get restricted and section 10 clause 10D will not give you exemption, the maturity proceeds will become taxable. So this was the erstwhile provision. Let me tell you friends, even in that amendment which has come, these provisions are not changed. They are still the same. However, along with these provisions, now you have to check something extra. Understand friends, why government brought that amendment? Since 10% of sum assured is also a sizable limit for policies which are having huge premiums. Friends, this amendment has come for people who started buying policies with huge amount of premiums, but making sure that the premiums were within 10% of sum assured. Like, imagine friends, if I am taking a policy which is having a sum assured of 1 CR, so 10% of that is still 10 lakhs. So if I am paying an annual premium of even 8 lakh rupees, even though I may not get ATC deduction because ATC is having a maximum cap of 150, doesn't matter. I'm not even concerned with ATC. I'm concerned with my maturity earnings. I hope you're understanding. If the policy is having 1 CR sum assured and 10% of that is 10 lakh, so even if I'm paying annual premium of just 8 lakh rupees, which is below 10%, and if I receive, after maturity of this policy, I receive, let's say, 126 lakhs, just a random figure, focus on the concept. If I'm getting 126 lakhs, that becomes fully exempt under section 10 clause 10D. So when government started realizing this, that all these high net worth individuals, they have started buying a huge amount of insurance policies having huge amount of annual premiums, but making sure that the premiums are within 10%. In such case, government had to do something, and that's why they brought an amendment which is effective from 1st April 2023 onwards, and it is not a retrospective amendment, it's a prospective amendment. So it is applicable for all the policies taken on or after this date. So the amendment says, if a life insurance policy is taken on or after 1st April 2023 and the annual premium is greater than 5 lakh rupees, either if the assessee has taken a single policy, then you have to check that greater than 5 lakh limit for that single policy, or if he has taken multiple policies, then you have to check the annual premium limit of 5 lakh for aggregate. You have to take the total annual premium of all the policies and then check whether it is more than 5 lakh rupees or not. So friends, if the policies are taken on or after 1st April 2023 and the annual premium is more than 5 lakhs, now irrespective of the fact whether it is less than equal to 10% or not, sir, you won't get section 1010D exemption on such policy. The maturity will become taxable. So in that earlier example which I had given, this 1 CR policy, if I have taken this policy in May 2023, can I say it is taken after 1st April 2023? So it is covered under this amendment. Now since I am paying an annual premium of 8 lakh for this policy, which was no doubt below 10%, but still government says since the annual premium is more than 5 lakh rupees, sir, the maturity proceeds of this policy will become taxable. So when you will get this 126, it will become taxable now. I hope you understood. Similarly, even if there are multiple policies, let's say in May 2023, I purchased a policy having sum assured 1 CR and the annual premium is, let's say, or let me reduce the sum assured. Let's say the sum assured is 40 lakh and the annual premium is, let's say, 4 lakh rupees. So again, exact 10%. So ideally it is okay. Another policy taken in June 2023, sum assured is 30 lakhs. Again, annual premium is 3 lakh. In such cases, friends, since the annual premium of aggregate policies exceeds 5 lakh rupees, that amendment is still applicable. And according to the amendment, if you are having multiple policies and the aggregate annual premium exceeds 5 lakh, exemption can be still taken for such policies whose aggregate premium doesn't exceed 5 lakh. So since here there are only 2 policies into question, one is having premium of 4 lakh, another is 3 lakh. Sir, I can still take the exemption for this one because the aggregate is not exceeding 5 lakh. For this policy, the premium is not exceeding 5 lakh. However, for this policy now, it will become taxable. I can't take because the aggregate of these 2 policies is exceeding 5 lakh now. So I can take the exemption only for such policies whose aggregate remains within 5 lakh. But for remaining policies, now it will become taxable. So this provision is applicable in this first MCQ and second MCQ. So let us see that first MCQ now. On the basis of the facts given above, choose the most appropriate answer to question number 1 to question number 5 below, based on the provisions of Income Tax Act 1961. Which are the life insurance policies in respect of which Mr. Akash would be eligible for exemption under section 10 clause 10D in respect of maturity proceeds? Choose the option most beneficial to Mr. Akash. Can I say, friends, since there are 5 policies, first of all, let me check this provision is applicable on which all policies. Can I say the first policy X issued in 2017. So for X, this provision is not even applicable. This amendment I am saying, this amendment is not even applicable. It is taken prior to 2023. This policy provision is applicable. This policy provision is applicable. And this policy also provision is applicable. Friends, this provision is not applicable to term insurance policies, because in term insurance policies, anyways, the maturity proceeds are not received till the time assessee is alive. Only if the insured person dies, then the family members will get the maturity proceeds. So this amendment of 5 lakh rupees is not applicable when the maturity proceeds are received on death of the assessee. So in case of this term insurance policy, anyways this provision is not applicable. Now, while checking this 10% criteria, friends, we have to check the premium excluding GST. GST will not be included in that calculation. So ignoring these figures, can I say annual premium? First, we will always check that earlier provision, that 10%, 20%. Since all these policies, now I'm just going to discuss this 4 because anyways term insurance is out of picture. Since the first 4 policies, they are taken after 2013, for all of them, first let us check that 10% criteria. Can I say sum assured 5 lakh, premium 40,000, so below 10%? So 10% condition satisfied for this one. Second policy again, 33 lakh sum assured, annual premium 3 lakh, so 10% criteria satisfied. 25 lakh sum assured, 2 lakh annual premium, 10% criteria satisfied. 27 lakh sum assured, 2 lakh 50,000 annual premium, 10% criteria satisfied. So friends, ideally you can see all the policies are satisfying that 10% criteria. So ideally, if that amendment would not have come, then the maturity proceeds of all these policies would have got exempted. But since that amendment has come now, that amendment is not going to affect this policy. So policy X is anyways exempt. Since it is not covered under amendment, policy X is anyways exempt. But what about policy Y, Z and A? Those 3 are covered under amendment. And since the annual premium is 3 lakh plus 2 lakh 5 lakh plus 250, it is 750. Since the multiple policies aggregate premium exceeds 5 lakh, now at the option of the assessee, only those policies maturity will be exempted, the aggregate annual premium of which do not exceed 5 lakh. So friends, I am having multiple options here. Like if I go with Y and Z, then the premium is 3 lakh and 2 lakh. So it is less than equal to 5 lakh. So I can go for this one option, wherein YZ will be exempt, A will be taxable. Second option I can go for is Z and A, wherein premium is 2 lakh and 2.5 lakh. So again it is below 5 lakhs. In that case, Y will be taxable. Or third option, I can go for Y or A, but in that case you can see the premium becomes 3 and 2.5, so 5.5. So sorry sir, this option is not available to you. Like you can't take this option. Or independently you can say Y is exempted because it is 3 lakh only, below 5 lakh, and Z and A will become taxable, but that won't be feasible. We must at least try to take exemption for 2. So ideally there are 2 best possible options. One is wherein you are taking exemption for Y and Z because the aggregate annual premium of these 2 policies is below 5 lakh. Or another option wherein you are taking Z and A exemption, wherein the aggregate annual premium is 4.5 lakh, which is below 5 lakh. In this case, A will become taxable. In this case, Y will become taxable. So if you have to say which one is better, sir, if A becomes taxable now, maturity proceeds of 30 lakh becomes taxable. Whereas if Y becomes taxable, then maturity proceeds of 36 lakhs becomes taxable. So the common sense says, obviously sir, you should go for this one, wherein you will claim the exemption for Y and Z and A will become taxable, because in that case you are still taxing only 30 lakhs. So when they say which of the life insurance policies would be eligible for exemption, choose the option most beneficial for Mr. Akash. X, Y and Z, that is first option. X was anyways exempt, and as we discussed, he can take the exemption for Y and Z as well. That is beneficial for him. So yes, X, Y, Z, that is one option. X and Y, that won't be feasible. X, Z and A, as I said, yes, X, Z and A, that is another option, but that is not giving me maximum advantage. And last is Y and Z, again I won't go for that, X is anyways exempt. So the answer will become A, wherein X, Y and Z, that will become exempted. So policy Y and Z can be claimed as exempt as the combined annual premium doesn't exceed 5 lakh. Policy A will become taxable. So the answer to this should be selected. This one, A, wherein we are saying X, Y and Z, that is becoming exempted. So if you see, ICI goes ahead with that one only, X, Y and Z. Okay, so that is first MCQ. Now second question, they are changing slide information. They are saying what would be our answer to MCQ 1? If Mr. Akash surrendered LIC A in AY 26-27 and claimed exemption under section 1010D in respect of such policy. This information is only for the purpose of MCQ, so we will not consider this in any income calculation otherwise. So just for the sake of MCQ, if they are saying if Mr. Akash surrendered life insurance policy A in the financial year 2025-26, that is assessment year 26-27, since he was planning to take X, Y and Z maturities exempted, but in 2026-27 assessment year, if he has withdrawn policy A, which he was earlier planning to get taxed, and he took exemption for it, then in that case, sir, your Y and Z which you wanted to take exemption, that option changes now. Like since you took the exemption for A, how much was the annual premium of A? It was 250. So sir, along with A, now if you try to claim Y as exemption in future when you will withdraw Y, premium becomes 550. Sir, that is not allowed. So along with A, since you already took A as exempt, in future now between Y and Z, you can take only Z as exemption, because your aggregate annual premium of Z and A has to be below 5 lakh. So that is 4.5 lakh. So since in that case Y will become taxable, my answer will change now. My answer will become X, Z and A. I should take the exemption for X, Z and A. So in the second case, I have to take the exemption for X, Z and A. So the answer is C in that case. So I hope this life insurance policy proceeds amendment is clear now, along with these first two MCQs. Now let us proceed. The remaining three MCQs are talking about deduction amount which will be available to Mr. Akash under chapter 6A if he is exercised the option to shift out of default tax regime. Friends, first of all, if you saw the question, how many deduction information you could see? Deductions under chapter 6A information in the question. Can I say one was that 80 TTA in respect of the saving bank account interest? Another was this 80D in respect of the health insurance. And please do not forget 80C in respect of this life insurance policy premium. Can I say since these policies are also running in the financial year 23-24, there must have been these annual premium payments even in 23-24, no? This annual premium of 40, 3 lakh, 2 lakh, 250, 80,000. So he has paid almost 325, 750, 830, 8,70,000 annual premium during that year. So can't he take 150 deduction out of that under 80C? Yes, he can take 150 deduction out of that. And even while taking deduction under 80C, don't consider that GST to be included in the annual premium. It has to be excluded. So now can I say there are three sections which he can take if he goes under optional tax regime, that is 80C, 80D and 80TTA. all the three will not be eligible if he goes under default regime. Only they will be eligible if he goes under optional tax regime. Now 80C, as we already saw, it can be taken 1,50,000. Deduction can be taken for any of those policies. However, I have specified the policy which was issued in the year 1st April 2023. But anyways, he can take for any of those policies. So 150 80C will be allowed. Health insurance, friends, 80D deduction is separate for self and family, and it is separate for parents. Now, since he is aged 47 years, considering even spouse to be near 47, 48 only, can I say nobody in self and family is senior citizen? So, the maximum deduction for self and family, including preventive health checkup, is anyways 25,000. Secondly, even for parents, since they are saying mother is aged 65 and father is aged 67, even though it is not clearly mentioned they are residents, but it is also not mentioned they are staying in Canada, US, etc. So, it will be safe to assume they are residents. So, can I say if parents are resident senior citizens, then for parents maximum deduction can be taken as 50,000. So, these are the maximum. Let us see the actual. Can I say for self and family spouse, there's a Mediclaim amount of health insurance amount of 13,500 paid by check, so qualifies. But for spouse, he has also paid a preventive health checkup which is in cash. Preventive health checkup paid in cash is allowed. Since it is 5,500, if you recollect, even though preventive health checkup is covered within that limit of 25, but there is an independent limit even for preventive health checkup itself, maximum 5,000 in a year. So, since self and family preventive health checkup pay is 5,500, it will be maximum restricted to 5,000. So, 18,500 will become the deduction for self and family spouse. Parents, as I said, assuming they are resident, can I say for mother, there's a Mediclaim amount, 26,670. So, I will consider that. For father, there is a medical expenditure. If father is resident senior citizen and he is not having Mediclaim, medical expenses can be claimed for him as a deduction. Mother is also a resident senior citizen, but since for mother, he is also having insurance premium, health insurance premium, for mother, medical expenditure cannot be taken. It is not that there is a choice. When an individual has health insurance, medical expenses don't even come into picture. So, that medical expenses has to be ignored for mother. So, for mother, health insurance 26,670, and for father, medical expenses 27,000. Preventive health checkup was there for mother also 5,500. But if you recollect, that limit of 5,000 for preventive health checkup is together for self and family and parents. So, since he has already taken 5,000 for self and family, he cannot take any deduction for preventive health checkup for parents. So, just these two figures, which are totaling to 27 and 26,670, 53,670. But as the maximum deduction cannot exceed 50, I will restrict this 53,670 to maximum 50. Lastly, there is a interest on saving bank account for which he can take 80 TTA. Since the actual interest is 16,000, so 16,000 or 10,000 maximum, 80 TTA is having a limit of 10,000. Whichever is less, so 10,000 will be allowed. So, if you take the total of this 150 plus 50, 2 lakh, 2,18,500 and 10,000. So, 2,28,500 is the maximum deduction which he can take. So, the option will be C, 2,28,500. Next MCQ is, what is Mr. Akash's tax liability for the assessment year 24-25 under the default tax regime under section 115 BAC? Friends, first of all, if he goes under default tax regime, then as I said, he won't be entitled for deductions under Chapter 6A, because for default tax regime, Chapter 6A deductions are not allowed except 80 CCD subsection 2 is still allowed, 80 CCH subsection 2 is still allowed, and 80 JJAA, that is still allowed. There's one more, but that comes in final. So 80 CCD subsection 2, 80 CCH subsection 2 and 80 JJAA. So this one was employer's contribution to NPS, 80 CCH was central government's contribution to that Agniveer Corpus Fund, and 80 JJAA, it is that deduction for employment generation. So since in this question none of these three are there, so anyways can I say if he goes for default tax regime, his entire deductions will be gone. All these deductions will be gone. We will just have to focus how much will be his taxable total income. Since his income from salary was given 45 lakhs. Now in the financial year 2023, there's an update that standard deduction for salary can be taken even under section 115 BAC. Till last year, 22-23, standard deduction was not allowed. But now at least standard deduction of salary gets allowed under section 115 BAC. So this 44,50,000 will be the income from salary. Income from capital gains is 6,54,000. Dividend from Indian companies is 12 lakh rupees, and 16,000 will be interest on saving bank account, and interest on FDs will be 45,000 as it is given. So if you take this total 44 lakh 50, 6 lakh 54, 12 lakh, 16,000 and 45,000, it should come around 63 lakh 65,000. Now under default tax regime, since his taxable total income will be 63 lakh 65,000, that is this figure before deductions under Chapter 6A. But yes, after standard deduction of salary. So on this 63 lakh 65,000, on the 63 lakh 65,000, you will calculate the tax. But I hope you recollect, whenever there are special rate incomes included, like in the 63 lakh 65,000, there's a special rate income, long-term capital gains under section 112A. Dividend is not a special rate income. Similarly, even interest is not a special rate income. So that 63 lakh 65,000, that will be split as follows. Out of the 63 lakh 65,000, this one is special rate income, 6 lakh 54,000. So the 654 will be taken separate. So 63 lakh 65,000 minus 6 lakh 54, 57 lakh 11,000 will be the other incomes. Now, out of the 654, which is special rate income, and this is slab rate income, out of the special rate income, which is LTCG under section 112A, you must be remembering that long-term capital gains up to 1 lakh, they are not taxable. So I will remove 1 lakh from this. 5,54,000, this will be taxable at 10%. So 55,400 will be the basic tax on this long-term capital gain. 55,400. Now there is slab rate income, this 5711, which I will have to split in this manner. First 3 lakh, 0%. You don't have to show this calculation, just you have to do it on the calculator. 0. Next 3 lakh, 5%. Friends, in default tax regime, the slabs are of 3 lakhs. 15,000. Next 3 lakh, 10%, 30,000. Next 3 lakh, 15%, 45,000. Next 3 lakh, 20%, 60,000. And above 15 lakhs, that is 57 lakh 11,000 minus 15 lakhs, 42 lakh 11,000 into 30%. 12 lakh 63,300. So if you take the total, you will get 14 lakh 13,300. Now, when you will take the total 14 lakh 13,300 plus 55,400, you will get the total basic tax as 1468,700. Now, since his total income is 63 lakh 65,000, which is more than 50 lakh rupees, can I say surcharge will also become applicable, and that rate will be 10%. No need to think about marginal relief, because marginal relief comes into picture only when the income increases marginally by 50 lakh. Here in this question, it is 63 lakh 65,000. We cannot call 13 lakh 65,000 increase as a marginal increase. Marginal refers to small. So don't think about marginal relief here. We will add surcharge 10%. So you'll get 16 lakh 15,570 as the basic tax plus surcharge, on which there will be 4% cess. So you will add it. You will get 16 lakh 80,193, which you will round off as per section 288B, which says total tax has to be rounded off in multiples of rupees 10. So 16 lakh 80,190. So that is option B, 16 lakh 80,190. So fourth one, option B. I hope clear. Now the last one. What is Mr. Akash's tax liability for the assessment year 24-25 if he has exercised the option to shift out of default tax regime? So friends, if he shifts out of default tax regime, can I say then he can take the deductions under chapter 6 also? In this question, there won't be any change in the gross total income, because anyway salary deduction is still allowed even under optional regime. So can I say now deductions under chapter 6A will also be allowed? So he'll take 80C 150, 80D 50,000 and 18,500, and 80 TTA 10,000. So if you subtract these three figures from 6365, you'll get 61 lakh 36,500. So 61 lakh 36,500. Now you have to calculate income tax on that as per optional regime. Friends, in optional regime also, you'll split the income. Since again special rate income is same, LTCG under section 112A, so 6 lakh 54. Slab rate income is 61,36,500 minus 6 lakh 54, 54,82,500. Now since 1 lakh long term capital gain is not taxable, 5,54,000 at 10%. So I hope you are understanding one thing, that the special rates of taxes, they are still same even under optional regime and even under the default tax regime. Both the regimes of default and optional, they are just affecting your slab rates, not the special rates. So 55,400 will be the special rate tax. Now this 5482,500 will be now split according to these slabs. Since he is not a senior citizen, take those general slabs which are applicable to all the non-senior people. 250 0%, so 0. Next 2,50,000 5%, so 12,500. 5 lakh rupees 20%, so 1 lakh. And above that, so 10 lakh above. 4482,500 30%. 1344,750. So if you add these two figures, 1457,250. Now when you will add that 55,400 to it, basic plus surcharge will be 15,12,650. It is total basic tax. So it is the total basic tax plus surcharge. If you add the surcharge to it, it will be again same 10% only. So 151,265. So 16,63,915 will be basic plus surcharge. 4% cess add to it. You will get 17,30,472, which again as per 288B round off in multiples of rupees 10. As long as the last digit is anything below 4, we do downward rounding off. If it is 5 or more than 5, we do upward rounding off. So 17,30,470. 17,30,470. Option A. Option A. So I hope with this, first 5 questions are clear. The MCQ based question based on the case study. So once again I summarize in this question. First of all, they are covering that amendment of the life insurance policies which has come under section 10 clause 10D. Secondly, they are testing you on the tax calculation of default tax regime and optional tax regime. The adjustments given are very limited, incomes given are very limited. Just 3 head incomes are given: salary, capital gain and other source. And deductions also very limited are given: ATC, ATD and ATTTA. So the calculation of tax under both the regimes should not be a challenging task. It is a very simple task here because not many adjustments are given. Now, next question, question number 6, which is again based on an amendment. Let us read the question first and then we will discuss the provision. Mr. Anil started business of manufacturing tables in February 2024. He follows mercantile system of accounting. He purchased wood from Mr. A, Mr. B and Mr. C. The details of purchases and payments made are as under. Instead of buyer, they should have written seller here, because Mr. Anil is actually purchasing the wood from Mr. A, Mr. B and Mr. C. So from the point of view of Mr. Anil, they are the sellers. He is purchasing, he is the buyer. Date of purchase is written, purchase amount is written, payment due as per written agreement if any, that is written, and date of payment is written. Mr. A, he is running a micro enterprise. Mr. B, he is running a small enterprise. Mr. A, he is running a medium enterprise. Some dates of purchase, amounts, payment due and date of payments are written. How much deduction would be available to Mr. Anil in respect of purchases made during the previous year 23-24 while computing business income? So friends, first of all, understand this question is from which chapter and which provision. Since they are asking you what deduction will be allowed while calculating business income, this provision, this question is from business income chapter. In business income chapter, friends, you have studied one section, section 43B, which says if a person is following accrual system of accounting, then also irrespective of his method of accounting, deduction for some expenses will be allowed only if they are paid. When I say they are paid, not up to 31st March, paid on or before due date of filing return of income. Friends, section 43B used to cover a list of 6 expenses: employer's contribution to various funds, then leave salary, then bonus and commission, then payment of taxes to government, payment to Indian Railways, and interest on loans taken from banks and financial institutions. So these 6 expenses government wants to allow as a deduction to the assessee only if they are paid by the assessee. When we say paid, they are not forcing you to make the payment up to 31st March. They allow you the time up to the due date of filing return. Friends, section 43B is a section which used to pinch all the people who are following accrual basis. Friends, people who are following accrual basis, they had an advantage. Even if an expenditure is not paid, it is just payable, they could have still taken the deduction of it by debiting that expenditure to the P&L. And as long as that expenditure was not disallowed anywhere else in this chapter, they ended up taking deduction for it. But what happens in this case is, once you get the deduction on accrual basis, you become casual with respect to the payment of that expenditure unless the payee is demanding it continuously. If the payee is not demanding it continuously, people become casual. They tend to hold these payments. Government doesn't want assessees to hold these 6 payments. They wanted people to make prompt payment of these 6 items. Because if you understand, these 3 are related to employees. They are for the benefit of employees. These 2 are related to government itself. And this one is related to banks and financial institutions. So government was thinking in the benefit of these people, employees, government themselves, and banks and financial institutions. That's why they made 43B, wherein till date purchases was not covered. When I say till date, I'm talking about till 31st March 2023. In 2023, amendment came. So friends, till 31st March 23, purchases were not covered in this list. So if this question would have been pertaining to 20 to 23 financial year, then anyways Anil has purchased some wood from 3 of the people. And if he follows mercantile system, doesn't matter when the payment was done, whether in this financial year or whether in the next financial year, he could have taken the deduction. But a very important amendment came even in section 43B, wherein a clause H got added. These all the payments were written under different clauses. So now a new clause H has got added, which is covering sum payable to micro and small enterprise. Friends, for the benefit of small companies, small associates, or you can say small business people, there's an act called as MSME Act 2006. This MSME Act has various provisions. Micro, Small and Medium Enterprises Act. It has various provisions which are benefiting small enterprises, micro enterprises and medium enterprises, which are as defined under that act. Benefits like they are entitled for getting timely payments from their customers. If they don't get timely payments from their customers, they have the right given under this act to charge interest from them. Similarly, if you are a MSME company which is registered under this act, you get bank financing at attractive rates of interest, etc. So there are many various benefits which are given to these MSMEs as per this act. Now, one of the benefit to them as per that act is section 15 of that particular act, which says if you are a MSME, section 15 says that if you are a MSME, then the payment should be done to you as per the section 15 of MSME Act. If anybody is dealing with the MSME, then payment should be done to that MSME as per the provisions of section 15 of MSME Act, which says if there's a written agreement, if there's a written agreement between the two parties, like if I take an example, if Mr. A, ignore our question as of now, if Mr. A, he is registered as a micro enterprise and there's a Mr. B, doesn't matter whether Mr. B is MSME registered or not. Focus on Mr. A who is MSME registered. If Mr. A has sold some goods to Mr. B, then since Mr. A is a micro enterprise, as per section 15 of MSME Act, Mr. A is entitled to get his payment on a timely basis. What do you mean by timely basis? If there's a written agreement between Mr. A and Mr. B specifying the due date for payment, like if Mr. A tells Mr. B through an agreement that whatever sale we do amongst ourselves, payments will become due in 30 days. In that case, Mr. A must get his payment within 30 days. If he doesn't get the payment within 30 days, beyond 30 days, he can start charging interest to Mr. B. Similarly, if the written agreement is specifying due date to be 60 days, then section 15 of MSME Act says, then Mr. A should get the payment within maximum 45 days. So whenever there is a written agreement, the due date is actually the actual number of days or 45, whichever is less. So if the actual due date is below 45, then whatever is the actual due date. But if it is more than 45, then maximum 45. So in 60 days due date, Mr. A is entitled to get the payment within 45 days. If Mr. B doesn't make the payment within 45 days, then beyond 45 days, Mr. A can start charging interest. How much interest will be charged, all that stuff is none of our concern. That is a part of MSME Act. We will not get tested on that stuff. However, if there is no written agreement, then Mr. A should get the payment in maximum 15 days, which is specified to be appointed date. As per MSME Act, they are writing the words as Mr. A should get the payment within appointed day, and that appointed day is nothing but maximum 15 days as per MSME Act only. So friends, bottom line is section 15 of MSME Act says that Mr. A, if he is a MSME registered entity and he is selling some goods to Mr. B, then Mr. A is entitled to get the payment as per the due date written under MSME Act. That is, if they are having a written agreement between them, then whatever is the actual due date or maximum 45 days, whichever is less, he should get the payment. Even if there is no written agreement, he should get the payment within maximum 15 days. If he doesn't get the payment within these dates, then he can start charging interest. That is section 15 of MSME. Friends, even though MSME Act was having this provision, MSME Act is since 2006. Even though MSME Act was having this provision, people hardly used to take it seriously. They were not bothered only. Like even if Mr. A starts saying, Mr. B, I am a MSME enterprise boss, please make me the payments within 15 days or within 45 days as the case may be. Mr. B never used to take him seriously. So finally income tax had to do something. So that is what they have done. They introduced this clause H. Now government is like, we will see how Mr. B is not making you the payment timely. We will not allow in the expenditure. So understand friends, now through clause H, which is added in 43B, government says, assessee, if any sum is payable by you to micro and small enterprise only. Friends, as of now, clause H is not talking about medium enterprise, only micro and small enterprise. So clause H says, if assessee, any sum is payable by you to micro and small enterprise, then make the payment as per section 15 of MSME Act. If you don't make the payment as per MSME Act section 15, then the deduction will not be allowed to you on accrual basis. It will be allowed to you on payment basis then. It will be allowed to in the year of payment. So understand friends, this clause H is slightly different than the earlier 43B, which is applicable to these 6 payments. For these 6 payments, since there was no other law which was operating or handling those 6 payments, so that's why for them government allows you time limit up to due date of filing return. But this payment is covered from MSME Act. So here they are not keeping the deadline as due date of filing return. Here they are keeping the deadline as deadline specified in MSME Act. So the wordings in clause H are make the payment as per due date of MSME Act, that is in that 45 days or 15 days as applicable. If you make the payment within 45 days or 15 days as applicable, only then the deduction will be allowed to you in the year of accrual. Otherwise, the deduction will get allowed in the year of payment. However, since as I said, this provision is not applicable to medium enterprise, let us see our question once again now. So first of all, now since this provision has come on purchases from micro and small enterprise. So let us revisit this question. Mr. Anil started business of manufacturing tables in Feb 24. He follows mercantile system of accounting. Friends, 43B is going to pinch only accrual basis people, because only they were having this advantage of claiming the deduction even if the expenses were not paid. So since Anil is following mercantile system of accounting, if he purchased wood from A, B and C, 3 people, on 15th Feb, 17th March, 25th March. So friends, if you look at the P&L of Mr. Anil, since all these 3 purchases from A, B and C have come up to 31st March, in his P&L, you will find this purchase of 5 lakh also. You will find this purchase of 7 lakh also. And you will find this purchase of 8 lakh also. Now, can I say, since purchases have also got covered as per 43B, however, only from micro and small enterprise, Mr. Okay, this third one is also Mr. A, sorry. So this is medium enterprise, this is micro, and this is small. So since his P&L is having these three purchases from Mr. A micro enterprise, Mr. B small enterprise, Mr. A medium enterprise, 43B clause H is not applicable to this one. And since it is not applicable to this one and Anil is following mercantile system, 8 lakh is anyways allowed. That is not the concern now. Irrespective of the payment, don't even look at the date of payment, otherwise it will confuse you. However, for A and B, payments from Mr. A and Mr. B, who is a micro and who is a small enterprise, now we need to check when the payment was done. In case of A, they are saying within 30 days from the date of purchase is the due date as per written agreement. So since there is a due date, it means there is an agreement. Second case, they are saying there is no written agreement. So since in the second case they are saying there is no written agreement, there is no due date specified. So as per MSME Act, 15 days becomes applicable. In the first case, since there is an agreement, 45 is the maximum, friends. But when the payment due date is specified in the agreement 30, we have to see 30 only. Now, since these 30 days and 15 days are applicable from these date of purchases, let us see. The first payment from Mr. A, which is a micro enterprise, as I said, for Mr. A medium enterprise, anyways this provision is not applicable. So, we will not even look at the facts and all those things of Mr. A medium enterprise. Deduction will be allowed in year of accrual only, that is 23-24. So, ignore that. In A and B, can I say since 43B is applicable, here since there is an agreement, the due date is 30 days. So, please count 30 days from 15th February 2024. Can I say 30 days from 15th February will become 16, 17, 18, 19 and again 10 days. So, basically from 29 days of February you have to exclude 15 days. So, 14 days of February plus 16 days of March. February is a leap year, don't forget 2023-24. In that Feb 24 is a leap year, February 29 days. So, 16th March becomes the due date as per MSME Act. Since the date of payment is after this due date, that is 16th March, the date of payment is given as 29th March. As per this amendment now, the deduction will not be allowed in the year of accrual, it will be allowed in the year of payment. But friends, in the first case, even the year of payment is 23-24. It is 29th March 24. So, can I say this clause H actually becomes ineffective for those payments which are even though after due date as per MSME Act, but which are done before 31st March. Yes, this clause H is ineffective for those payments which are even though done after due date as per MSME Act, but which are done before 31st March, because in that case, even if you apply year of payment logic, still it will be financial year 23-24 only. However, now for Mr. B, who is small enterprise, can I say since the date of purchase is 17th March and there is no written agreement, so 15 days due will become applicable. So, if you check the number of days, 17th March, so up to 31st March, can I say 31 minus 17, 14 days of March plus 1 day of April. So, the due date as per MSME Act was 1st April, and since the payment is done on 15th April, can I say it is done after the due date? So, even here the deduction will be allowed in year of payment, and this time the payment year is 24-25. Now see, that's why I told you earlier that this clause is not allowing you time till due date of filing return. Otherwise, someone will say, sir, even though it is 15th April, but at least it is paid up to due date of filing return. Clause H is not telling you up to due date of filing return, it is telling you as per the due date as per MSME Act. So, since it is surpassed, deduction will be allowed in year of payment, which is 24-25. So bottom line is, can I say this one allowed, this one allowed, this one not allowed in 23-24? So yes, 5 lakh plus 8, 13 lakhs will be allowed. So the answer will be 13 lakhs. That is solution C. Clear? Okay. Now next question, question number 7, which is on TCS provision. Let us first read the question. Mr. Sunil took an education loan of 8 lakhs on 1st July 2023 from State Bank of India, Mumbai, for his son's MBA from University of Oxford, UK, and remitted the said amount through the same bank, which is an authorized dealer, under the liberalized remittance scheme of RBI LRS. So Sunil has taken an education loan, 8 lakh rupees from some bank, and he has remitted it through the same bank, which is an authorized dealer under LRS scheme, for his son's MBA education. He further remitted 2 lakh rupees on 15th October 23 to his son for his personal expenditure out of his personal savings through Bank of India, Mumbai, which is also an authorized dealer under LRS. So another remittance. Mr. Sunil also remitted 6 lakh rupees on 28th March 24 out of his personal savings under LRS through Union Bank of India, Mumbai, for his sister's medical treatment in London. Sunil has furnished undertaking containing the details of earlier remittance to Bank of India and Union Bank of India. Understand, friends? In this question, Mr. Sunil is making 3 foreign remittances under the liberalized remittance scheme of RBI. Now, what is liberalized remittance scheme of RBI? That is actually not going to get asked to us, but just for your information, it's a remittance scheme came under FEMA, wherein you are permitted through by RBI to freely remit some amount of USD. I will not specify the limit as of now because unnecessarily it will confuse some students. So there is some minimum amount of USD which you can freely remit through liberalized remittance scheme outside India, and it's a decent limit. But anyways, the scheme is just for remittance purposes. When you are supposed to make any remittance outside India, you are making the remittances under this scheme only. Since you people must be aware that government since last few years is trying to improve the reporting mechanism, for which they are introducing new sections of TDS and TCS. I hope you people are aware that TDS and TCS, they not only give some taxes in advance to government, but the biggest help government gets through TDS TCS provisions is information, reporting. They get to know about the incomes and expenses of people. So there was a section 206C subsection 1G which was introduced in TCS provisions, which brought TCS on foreign remittances. Even this section has undergone a very big change, section 206C subsection 1G, wherein TCS on foreign remittances rates have got revised. If you people know the earlier provision, what was the earlier provision before this amendment came? They were saying if you purchase an overseas tour package, you want to go for some vacation purpose like Switzerland, Bali, etc., and you are purchasing some overseas tour package. In that case, TCS was applicable 5% without any threshold. Even if your package is just worth 40,000 rupees, there will be 5% TCS collection on that. However, if you were making a remittance for education purpose by taking loan from a financial institution mentioned under section 80E, I hope you remember 80E deduction section, wherein loans from financial institutions for education purposes were qualified for deduction, interest on loan taken. So anyways, the definition of financial institution is written under section 80E. So if you're making a remittance for education purpose by taking a loan from financial institutions, then TCS rate got reduced to directly 0.5% on amount in excess of 7 lakh. Similarly, if you are making the remittance for any other purpose, even if education purpose, but by not taking a loan, for any other purpose, like you want to remit some money to your family members just for their expenditure outside India, or you want to make some remittances for medical treatment, etc. outside India. So prior to this amendment, all these purposes were covered under any other purpose. So there was again TCS of 5% on amount in excess of 7 lakh. So these were the earlier provisions, wherein purchases for overseas tour package, there was 5% TCS without any threshold. Remittance for education by taking a loan from a financial institution, 0.5% TCS on amount in excess of 7 lakh. Remittance for any other purpose, again 5% TCS on amount in excess of 7 lakh. Now friends, in 2023-24, from 1st October 23, during the financial year, from 1st October 2023, these rates have undergone some change. So now you have to remember this revised table, which says if the remittance is for education or medical treatment, not by taking loan, you are sending money outside India for education or medical treatment. So earlier medical treatment used to get covered under this only, any other purpose, but now medical treatment is also separated, but effective from 1st October. So ideally you have to check this provision now, prior to 1st October the earlier rates, and after 1st October this revised rates. But a revised table has only got issued even before prior to 1st October. So now no need to remember this old rates only, this old table only. Now just focus on this new table, wherein before October, after October, both rates are given. So pay attention. If the remittance is for the purpose of education or medical treatment, but not by taking a loan for education or medical treatment, in that case, they are saying no TCS up to 7 lakh. But 5% of the amount or aggregate of amounts in excess of 7 lakh. See, they are talking about loans other than loans only for education purpose. In medical treatment, they have just written medical treatment. So ideally for medical treatment, the source of funds doesn't matter. But for education purpose, it should be other than loan, because loan gets covered under the next point. So remittance for purpose of education other than loan and medical treatment, source of funds doesn't matter. There's no TCS up to 7 lakh. 5% of the amount or aggregate of amounts in excess of 7 lakh, even before 1st October, even after 1st October. So in this, there's no change. Remittances out of loan obtained from any financial institution referred under 80 for the purpose of pursuing any education, in that case again no TCS up to 7 lakh, but 0.5% of the amount or aggregate of amounts in excess of 7 lakhs. However, Now for remittances for purpose other than those mentioned in first and second, it means other than education purpose remittance, and whether with loan or without loan doesn't matter, or other than medical treatment, source doesn't matter. For other purposes, like you want to send some money to your relative, whatsoever purpose, but not education, not medical treatment. You want to purchase some properties outside India for which you want to make some payments outside India. All those payments will get covered under remittances for any other purpose now. In such case, no TCS will be applicable up to 7 lakh prior to 1st October. And even after 1st October, there will be no TCS up to 7 lakh. However, 5% of the amount or aggregate of amounts in excess of 7 lakh up to 1st October rate, and after 1st October, the rate will become directly 20%. So understand, individually, let me take an example. If I talk about this one, education purpose, if on 15th September 23, I am making 8 lakh rupees education purpose remittance to my son who stays in US, but without taking a loan. So in that case, since it is before 1st October, out of this 8 lakh, on 7 lakh, no TCS. 1 lakh, it will be 5%. Okay. Similarly, even if this date was 10th October 23, that is after amendment, still if the purpose remains same, education purpose without taking a loan, then also the limits are same. So then also up to 7 lakh no TCS, above 7 lakh that is 1 lakh, 5%. However, if I say I have taken a loan and sent this 8 lakh rupees, then also prior to 1st October also 7 lakh no TCS, in excess of that 0.5% TCS. Even if it is after 1st October, still up to 7 lakh no TCS, above 7 lakh 0.5% TCS if it is a loan, education loan. However, any other purpose remittance, like if I want to send some money to one of my relative, maybe as a gift, let's consider I want to send some gift money to a relative. See, we are not talking about the taxability of that gift here. Some students start thinking, sir, if you are sending a money to your relative as a gift, so anyways gifts to relative are not taxable. Doesn't matter. We are not talking about taxability of that income here. We are talking about applicability of TCS provisions here. So even if the purpose of giving that money is a gift, doesn't matter. I'm making a remittance. So that is what matters. So if my remittance is 8 lakhs, so now the date matters a lot. Because if the date is 15th September 23, up to 7 lakhs, no TCS. Above 7 lakh, that is 1 lakh, 5% TCS. But sir, if the date is 10th October 2023, since it is after this amendment, then sir, up to 7 lakhs, no TCS, 1 lakh, straight away 20% TCS is applicable. Similarly, what if you are purchasing overseas tour program package? Then anyways, there was no threshold for that. So if I want to go Switzerland, I have purchased a package for that. And let's say it is purchased on 15 September 23, the package is worth 10 lakh rupees. So sir, anyways on tour program packages, there was no threshold. So on 10 lakh, entirely 5% TCS will be applicable. However, if the purchase is on 10th October 23, friends, now in tour program, they have not kept threshold as such, but they have kept separate rate after 1st October till 7 lakh. That is that old rate only 5%, but above 7 lakh, they are making 20%. So now if this purchase of overseas tour program package is after 1st October, then out of this 10 lakh, on 7 lakh, 5% TCS, and on 3 lakhs, 20% TCS. So I hope the provision is clear first. Now, there were some challenges people faced for which they asked for clarification. Challenges namely, sir, what if I am making multi-purpose remittances during the year? I am also purchasing a tour package. I am also making a remittance for education purpose to my child staying outside India. I am also making some remittance for medical treatment. Will this limit of 7 lakh, threshold of 7 lakh, apply for each remittance? Government clarified. They have issued certain guidelines which you can read from the statutory update PDF at a later stage. But let me just summarize. Government clarified that no boss, if you are making multi-purpose remittance, tour program, anyways there was no threshold. So keep it separate only. Other payments, like if you are also making a medical treatment payment, you are also making a education purpose payment, remittance, then there will be no 7 lakh, 14 lakh threshold. There will be a combined threshold of 7 lakh only in chronological order. So whatever was your first remittance, that will be entitled for that 7 lakh threshold. Other remittances will not be eligible for any threshold again. That was one clarification. Secondly, people started asking, what if these remittances are from different dealers, different authorized dealers? So will every authorized dealer will check different limits? Again, government has issued clarification that no boss, it is not for each remitter separately. That limit is for all the remitters together. So you will have to give that information to the remitter every time. Wherever you are making that remittance, you will have to tell them about your earlier remittances. So now in our case, let us see, and there is also one clarification regarding what will be considered as medical treatment expenditure, what will be considered as education. So for that, they have written some clarification that medical treatment will include purchase of tickets for medical treatment going outside India and coming back, and then medical expenses as well as the other day-to-day expenses. Same thing for education, they have clarified that what will be considered as education remittance, payment for purchase of tickets for traveling outside India to study, then any tuition or other fees which is to be paid to that educational institute, as well as other day-to-day expenses. So let us understand our question now. We will not get into that guidelines completely. Let us see our question now. Once again, revisit the question. Mr. Sunil took an education loan of 8 lakh on 1st July 23 from State Bank of India, Mumbai for his son's MBA form, University of Oxford. So there is one remittance which is to son on 1st July, which is for education purpose. The amount is 8 lakh. It is for education purpose, source is education loan from State Bank, which is a financial institution covered under ATE. He further remitted 2 lakh on 15th October to his son for his personal expenditure out of his personal savings through Bank of India. So there's one more remittance on 15th October, purpose is personal expenditure of his son and source is personal savings, 2 lakh rupees. Then he also remitted 6 lakh rupees on 28th March out of his personal savings under LRS through Union Bank of India for sister's medical treatment. So there's one more medical treatment happening on 28th March for sister. There is one more remittance happening on 28th March, which is for medical treatment of sister, sources personal savings. Mr. Sunil has furnished the undertaking containing the details of earlier remittances to Bank of India and Union Bank. So to every remitter, he is giving that information about the earlier remittances. What is the amount of tax to be collected from Sunil in respect of remittance of amount to his son and sister? In this case, friends, if there would have been any purchase of overseas tour package, then we would have anyways kept that separate only. But since there is no purchase of tour package, there is education purpose, personal expenditure and medical treatment. Each one of this ideally had that 7 lakh threshold. But the point is, when all these three are done together, even though not on the same day, doesn't matter, but in the same financial year, will the threshold of 7 apply to each one of them? Then the answer is no. The clarification has got issued which says it will be a combined threshold for all the three. So anyways, out of this 16, you can consider that the threshold will be 7 eligible only for the first remittance which is coming in chronological order. So only on this first remittance which is done on 1st July, there will be no TCS up to 7 lakh because it is education loan and for education purpose, no TCS up to 7 lakh. After that, on 1 lakh rupees, TCS will be 0.5% because it is education loan and education purpose. So it will come in this category. Second one, no TCS up to 7 lakh, 0.5% of the amount or aggregate of amount in excess of 7 lakh. So 1 lakh into 0.5%. Secondly, on second remittance which happened in 15th October, now since 7 lakh threshold is already exhausted, so now you won't get any new threshold. This personal expenditure is coming here. Remittances for purposes other than those mentioned in 1 and 2. So ideally there was a threshold, but it will not be applicable anymore. So on this 2 lakh rupees, now there will be TCS. Look at the date. Since it is 15th October, can I say it is after 1st October? So directly 20%. So on that 2 lakh rupees, 20% TCS will be applicable. Similarly, 5% was applicable only up to 30th September. Similarly, the third remittance which is done on 28th March 2024, can I say again, since the threshold is already exhausted, on this medical treatment, it comes here in the first one, medical treatment. The rate is 5% only even before 1st October, even after 1st October. So since the payment is done on 28th March, 6 lakh into 5% TCS will come. Rate is 5% only before 1st October, after 1st October. So the TCS will be as follows. No TCS up to 7 lakh, TCS of 0.5% on 1 lakh, 20% on 2 lakh and 5% on 6 lakh. So let us see where is this one. 0.5, 1 lakh, 5% 2 lakh. No, this option is out. 0.5, 1 lakh, 20% 2 lakh and 5% of 6 lakh, correct. The correct option is option B. Option B, wherein TCS 0.5% on 1 lakh, 20% on 2 lakh and 5% on 6 lakh. So option B. Clear? Now, next one, 8th question. Mr. Garg, aged 45 years and a resident in India, is having a total income of 570 comprising of long-term capital gains taxable under section 112 of 70,000. So this is just a calculative question. Garg having total income 570, fine, total income 570. They are giving you the breakup, which includes 112 70,000. So LTCG 112 70,000. Friends, whenever they don't give you exact details of what is that 112 capital gain, always take the rate 20%. Because in 112, 10% rate was only for listed securities and zero coupon bonds, that too at the option of the assessee, and only for a non-resident selling unlisted securities. For rest all the other assets, it was anyways 20%. Now, next they are saying long-term capital gains taxable under section 112A. Okay, fine. Long-term capital gains 112A. It is 150. Short-term capital gains under 111A, 1 lakh. STCG 111A, 1 lakh. And other income of 2 lakh. So this must be slab rate. 2 lakh 50, sorry. Compute his tax liability under default regime. Fine. So under default regime, we have to find the tax liability. Doesn't make any difference as such, except the slab rate difference. Like when I say doesn't make any difference, no difference as such in deductions, exemptions. These incomes which they have given, we will have to assume it is before deductions and exemptions, which are not allowed in default regime. So anyways, income will remain same, 570. All we have to do is think about the tax calculation. Friends, in this question, there will be multiple options to calculate the tax. Why? Understand. Let me tell you the first one. Since this 570 is having some slab rate income and some special rate income, let me split. Slab rate income is 250 and special rate there are 3. 111A 1 lakh, 112 it is 70,000 and 112A. We had done such an example even during lectures. 112A is 1,50,000. So friends, now since this is his income on which we have to calculate tax, slab rates, if you recollect, under default regime, the basic exemption limit is common, 3 lakh rupees for everybody. Since the slab rate income is below 3 lakh, no tax as per slab rate income because the income is below basic. However, there is an unabsorbed basic exemption limit of 50,000. Unutilized basic exemption limit because the income is only 250 whereas the basic exemption is 3 lakh. So there is an unutilized basic exemption limit of 50,000, which since he is resident individual and resident HUF, they can adjust their unabsorbed basic exemption limit, unutilized basic exemption limit against a special rate income under 111A also, 112 also, 112A also. So we'll see against which income we are adjusting. This one is taxable at 15%, this one is taxable at 20% and this one is taxable at 10%, but only in excess of 1 lakh. So friends, first option is, so when I said there are multiple options, those options are actually coming into picture because of the different rates of special rate income. So we should adjust that 50,000 wherever it will be most beneficial to us. So if we think that let us adjust it against this 20% income because that is going to get taxed at a higher rate. If I adjust this 50,000 here, after adjustment of this unabsorbed basic exemption limit, my short-term capital gain 111A is 1 lakh. 112 is 20,000 and 112 is 1,50,000. Now if I calculate tax on 1,15%, 15,000, on 20,000, 20%, 4,000, and out of 1,50,000, I will exclude 1 lakh and only on 50,000, 10%, 5,000. Because LTCG up to 1 lakh rupees under section 112A is not taxable. So we will not calculate any tax on that. Only on the excess, 50,000 will calculate 10%. So this will be my basic tax, 15 plus 4, 19, 24,000. Now, since the assessee is individual, resident, and total income is below 7 lakh rupees, less than equal to 7 lakh. Therefore, he will be entitled for rebate as well. Because in default tax regime, if the individual person is individual, resident and the total income is less than equal to 7 lakh, assessee is entitled for rebate. Now, since the 3 conditions are satisfied, I can take the rebate. How much is the rebate under default tax regime? It is basic tax actually calculated or maximum 25,000, whichever is less. Now, since here basic tax is 24, we should take entire 24, na? because it is below 25? No. Rebate is not allowed against long-term capital gains under section 112A. So since rebate is not allowed against under section long-term capital gains under section 112A, we can't take any rebate against this 5,000. We can take the rebate of only 19,000 maximum. So 5,000 basic tax will remain, on which there will be no surcharge, but cess will be there. Health and education cess 4%. So 200. So 5,200 will be the tax. So the correct option is B. So if any student was getting answer as A, that is nil, you were allowing complete rebate, which is not allowed under section 112A. This was one option. Now a student can start thinking about other alternatives also. But let me tell you, this one is still better, because another alternative could have been, you would have adjusted this 50,000 against that 112A to get rid of it. So if you do that, let me do that also. Slab rate is 2,50,000. Basic exemption 3 lakh. So there's an unabsorbed basic exemption limit of 50,000. Special rate 111A is 1 lakh. 112 is 70,000. And 112A is 150. So if you try to do this, you adjust this 50,000 against this to get rid of this first, because this is another option. In that case, STCG remains 1 lakh, 112 remains 70,000, and this becomes 1 lakh. Now if you calculate the basic tax, this will be 15,000, 15%. This will be 20%, 14,000. And this will become 0, because on LTCG up to 1 lakh rupees under 112 there is no tax. So it will be 29,000. Friends, in that case, now since the total income is individual, the person is individual, he is a resident, and ultimately he is individual, he is resident, and ultimately since the total income is below 7 lakh, he is still entitled for rebate. So in this case, he can take the rebate, which will be basic tax 29,000 or up to 25,000 maximum, whichever is less. So here he can take the rebate of 25,000. So you will see 4,000 will become the balance amount, on which cess will be 4%. So 4160, but if you see, this option itself is not there. Ideally, this option is better. You can surpass that 20%. You can surpass that. Instead of adjusting against LTCG 112, you can first adjust against 112A. Theoretically, you can do that calculation. You can evaluate that possibility. In that case, you will be benefited. But since ICI has not given that option only, we'll have to select this one, 5,200. I hope it is clear. If that option would have been there, you should have selected that option only. Now the next one, Miss Rita, an Indian citizen and a MBA from Harvard University, was employed in AFL LLP of country A since June 2016. She came to India on 15th November 2023 and joined as CEO of Autofit Limited. Ms. Rita was in India before she left for overseas education in May 2012 and was subsequently employed outside India and never visited India thereafter. There is no income tax in country A. She has earned interest income of 2,40,000 net in country A and a salary income of AFL LLP of 15 lakhs up to the date of her return to India in the financial year 23-24. Salary computed of Miss Rita from Autofit up to 31st March 23 is 13,50,000 and she earned a dividend of 3 lakh from the shares of an Indian company. Question is asking you what would be the residential status of Miss Rita and her total income for the assessment year 2024-25. So friends, first of all, let us jot down the facts of this case. They are saying Miss Rita, she is an Indian citizen. She was employed in AFL LLP of country A since June 2016. So getting a salary income from this company, country A, which is located outside India. Salary income from this company was 15 lakh up to 14th November 23. ₹15 lakh. Okay. And interest income of 2,40,000 in country A. So even there is an interest income 2,40,000. Even this is in country A. So practically both are incomes earned and received outside India. Salary income of Miss Rita from Autofit Limited. On 15th November 23, she came to India and got employed in Autofit Limited. The salary from this company up to 31st March is 13,50,000. And she earned a dividend of 3 lakh rupees from shares of Indian company. So there is dividend income. These salary figures are computed. The salary figures of Indian company, they are computed. So it means they are after standard deduction. She earned a dividend of 3 lakh rupees from shares of Indian company. Okay. Fine. What would be the residential status of Rita and her total income? Fine. So basically this question is on determination of residential status and finding out the scope of total income. Let us first focus on determination of residential status. Friends, an individual, Rita is an individual. An individual is resident of India or a non-resident of India based on two basic conditions. Basic condition A says number of days stay in India during the previous year has to be greater than equal to 182 days. Whereas basic condition B says number of days stay in India during the previous year has to be greater than equal to 60 days and during 4 preceding previous years has to be greater than equal to 365 days. These are the two basic conditions for determining the residential status based on physical presence. There are 3 individuals to whom this basic condition B is not applicable. So to those individuals we call exceptions to basic condition B. First one is Indian citizen leaving India during the previous year for employment outside India. So is Miss Rita leaving India during 23-24 for the purpose of employment outside India? No, rather she is coming to India. So first exception not applicable. Second exception, Indian citizen leaving India during the previous year as a crew member of Indian ship. Is she a crew member of Indian ship? No. Second exception also not applicable. Third exception, Indian citizen staying outside India, coming to India during the previous year for visit and the total income excluding foreign sources. So total income excluding foreign sources, which in our case is the above two income 15 lakh and 240. but including the incomes in India, including that income from business or a profession earned and received outside India having control or setup in India. So in this question anyways, there is no business or profession income earned and received outside India having control or setup in India. So ignore that. Basically that 15 lakh limit is to be just check on this Indian incomes, ignoring those two foreign incomes. So can I say friends, she is an Indian citizen staying outside India, coming to India during the previous year, and her total income excluding foreign sources, that is excluding these two, only Indian income, that is 1650, which is greater than 15 lakh. So she is covered under the exception, third exception? No, she is not covered under the third exception also friends. Why? Because friends, she is not coming to India for visit. See friends, she has come to India on 15th November 23 and joined as a CEO of Indian company. And since the question is not telling anything after that, whether she is again going back or not, it is implied that she has come here permanently. Like there is some degree of permanence involved. Even though in future she may again go back, but that is in future. We never know right now. So since as of now there's a degree of permanence, she has joined an Indian company when she came on 15 November. She is not going to immediately go back. So her coming to India on 15 November can't be considered as a visit now. So even though she is an Indian citizen staying outside India, coming to India during the previous year, and her total income excluding foreign sources is more than 15 lakh, still she is not covered under exception as she is not coming for visit. So anyways, both the basic condition applicable, 1 also applicable, 2 also applicable. See, even though her total income is more than 15 lakh, like even if she would have come for visit now, she would have still not get covered under exception. Rather than modified basic condition B would have become applicable to her, because her total Indian income is more than 15 lakh. If it is less than equal to 15 lakh, then she would have got covered under exception. Otherwise, modified basic condition be applicable, but to her, even modified condition is not applicable, the original condition is applicable. So we'll have to check both the conditions. If you check first condition, for that first you need 23-24 stay. Since she is coming on 15th November 23, can I say date of arrival and date of departure they are considered in India? So out of 30 days of November, exclude 14 because 15th will be counted in India. So 16 days of November, December 31, January 31, Feb 29, March 31. So 138 is her stay. Therefore, first condition not satisfied because it is below 182. Friends, second condition, subcondition 1 satisfied, previous year more than 60 days. But will she satisfy 4 preceding previous year's condition? She will not satisfy friends, because look at the information clearly. They are saying Miss Rita was in India before she left for overseas education in May 12 and was subsequently employed outside India and never visited India thereafter. So this implies that prior to 15th November 23 and from May 2012, she never came to India. So her 4 preceding previous year stay will not be 365, more than 365, it will be 0. Satisfying basic condition B subcondition 1 without satisfying basic condition B subcondition 2 is of no use. She will still end up becoming non-resident based on physical presence. Friends, if an individual becomes non-resident based on physical presence, earlier we used to end the answer there itself. But with effect from 2020, section 6 has a new sub-clause. New clause got inserted, clause 1A, which talks about deemed residency. So now we'll have to check deemed residency for her. Friends, never check deemed residency if an individual becomes resident because of physical presence itself. Only when an individual becomes non-resident because of physical presence, then go and check the deemed residency criteria. Now, deemed residency criteria has again 3 conditions. First condition, must be Indian citizen. Second condition, total income excluding foreign sources, but including income from a business or a profession earned and received outside India, having control or set up in India, greater than 15 lakhs, and not liable to pay tax in any country for whatsoever reason, doesn't matter whether due to domicile or whether due to residency, doesn't matter, but not liable to pay income tax, or you can just say not liable to tax in any country because of any other reason. So now revisit the facts of the question. Rita is an Indian citizen. Her total income excluding foreign sources but including Indian income, those Indian incomes, it is greater than 15 lakh, 16 lakh 50, and she is not liable to pay income tax in any country. They are clearly saying there is no income tax in country A. So friends, can I say she becomes a deemed resident of India? Since she becomes a deemed resident of India, deemed residents are directly RNOR. Sir, but she is liable to pay tax in India, na? Yes, while checking deemed residency, we don't consider India into picture, we just check other countries. So she is not liable to pay tax in any other country, then yes, deemed residency will become applicable. So she is RNOR. Now, once we have determined the residential status, now understand the scope of total income. Friends, for a ROR, global income is taxable. For a NR, only Indian incomes are taxable. But for a RNOR, Indian incomes are taxable plus one foreign income is taxable, that is income from a business or a profession earned and received outside India having control or set up in India. And what are considered as Indian income? Incomes received itself in India, incomes accrued itself in India, incomes deemed to be received in India, incomes deemed to be accrued in India. So in our case, can I say now, since she is a ROR, the scope of her total income will include this salary from India, because it's an income earned itself in India, 13 lakh 50. It will include that dividend income from India, because even this is income deemed to be accrued in India. It is a dividend paid by Indian company. Friends, these two incomes will not be considered. The salary from AFL LLP, because that is an income which is earned and received outside India. If she would have ended up making a mistake of receiving that income in India, then we would have included that income also. But since the question is not saying where that money was received, it's a by default assumption it was received outside India. Similarly, this interest income of outside India, even that is not taxable for her, because that is also an income earned and received outside India which is not taxable to a RNOR. So her total income is only 1650. So you can see the answer. As per section 6 clause 1, in order to be a resident of India in the previous year 23-24, Ms. Rita should satisfy either of the two following conditions. Her stay in India should be for a period of 182 days or more in the previous year 23-24, or her stay in India should be for a period of 60 days or more in the previous year 23-24, and for a period of 365 days or more in the 4 immediately preceding previous years. Ms. Rita's stay in India in the previous year 23-24 is 138 days, 16 days plus 31 plus 31 plus 29 plus 31, that is 138. She left India in May 12 and never visited India thereafter. Her stay in India in the 4 preceding previous years would be therefore nil. Therefore, she will not satisfy either condition 1 or condition 2 for being a resident. As per section 6 clause 1a, an individual who is citizen of India would be a deemed resident of India if his total income other than income from foreign sources exceed rupees 15 lakh during the relevant previous year, and he is not liable to tax in any other country by the reason of his domicile or residence or any other criteria of similar nature. Miss Rita's total income other than the income from foreign sources would be 1650 as shown below, that is 1350 plus 3 lakh 50 is 16 lakh 50. Since Miss Rita is a citizen of India who is not liable to pay income tax in country A and her total income other than income from foreign sources exceeds 15 lakh, she would be a deemed resident of India under section 6 clause 1A of us for the assessment year 24-25. A deemed resident is by default a resident but not ordinarily resident. In case of a resident but not ordinarily resident, income accrues or arises, deemed to accrue or arise and received or deemed to be received in India is taxable. In addition to that, as I said, one foreign income also. Income which accrues or arises outside India would also be taxable if it is derived from a business which is controlled in India or a profession which is set up in India. So her total income will be just including auto-fit salary and dividend. Those two foreign incomes will not be included. Sir, what if she is ROR? All the four incomes will be taxable because global incomes are taxable. What if she is NR? Same answer. Because there is no business income having control or setup in India. Next question. Mr. Raj, a resident in India, owns two house property. One in Delhi, one in Kanpur. So, Raj is having two house properties, Delhi, Kanpur. The property in Kanpur is self-occupied by Raj. Okay, so Kanpur one is self-occupied. The property in Delhi is let out throughout the year. Fine. This is let out. The particulars of the Delhi house for the previous year 23-24. So this let out property. Standard rent 172, municipal value 2,05,000, fair rent 195. So can I say, friends, expected rent is municipal value 2,05,000, fair rent whichever is higher 2,05,000, standard rent whichever is less, compared to standard rent whichever is less. So 2,05,000 or 172 whichever is less, expected rent is 172. Rent received is 15,000 per month. Now since they are saying that the property is let out throughout the year, can I say the actual rent, since they are saying rent received 15,000 per month, so 15,000 into 12, 180. Now in this question, they have not given you any unrealized rent or any vacancy period. If there would have been unrealized rent, we would have subtracted that from the actual rent and then net actual rent we would have considered for vacancy adjustment. But since there is no unrealized rent only, this actual rent will be as it is. Similarly, since there is no vacancy, there is no treatment of vacancy to be done. We will directly get the gross annual value by comparing these two figures, whichever is higher. So 180 will be the gross annual value. Minus municipal tax. When you take the deduction for municipal tax, you must remember, friends, municipal tax is allowed as a deduction only on payment basis. Municipal tax is allowed as a deduction only if it is paid by the owner, and interest on municipal tax is not allowed as a deduction. Now, since they are saying municipal tax paid by Raj is 5% of municipal value, 2,05,000 into 5%. 10,250. So 180 minus 10,250. The NAV of Delhi house will be 169,750. And the NAV of Kanpur house is anyway 0 because that's a self-occupied property. Then municipal tax paid by Raj on 10th June 2023 for Kanpur house is 3,500. Sir, will not be allowed because it's a municipal tax of SOP, not allowed. Mr. Raj has taken a loan from SBI of 35 lakhs at 12% per annum in April 2021 for the purchase of Delhi house. Friends, they are saying for Delhi house, that is the let out property, there was a loan taken of 35 lakhs from SBI at 12% per annum in April 2021. Point to be noted. The stamp duty value of this house was 40 lakhs. Okay. Mr. Raj purchased a plot in Kanpur. So they are talking about Kanpur property now. No repayment has been done so far for both the loans. So since for SBI loan also 35 lakh, no principal repayment has been done. Can I say if I try to find out the interest? See, anyway, standard deduction will be 169,750 into 30%, 50,925. But interest, when we will try to find out, friends, in interest, can I say first I have to take let out a property. So 35 lakh rupees loan is outstanding into 12%, 4.2 lakh. So 4.2 lakh is the interest. Mr. Raj purchased a plot in Kanpur in May 21 and the construction of the Kanpur house was begun in June 2021 and was completed on December 22. Mr. Raj took a loan of 25 lakh at 10% for the construction of this house on 1st July 21. Understand, friends, for let out a property, we have understood the interest is 420. We'll come back to that later. Once again, let us find the interest for SOP. Friends, in SOP, Kanpur, they are saying a loan of 25 lakh was taken on 1st July 21. So, date of taking loan is 1st July 2021 and construction was started in the year June 2021 itself. So, fine, anyways, construction is prior to that. Plot was purchased again earlier, May 2021, doesn't matter. So, date of loan is a later date. And construction got completed in December 22. So, friends, whenever you see that a loan is taken for construction and the construction has taken time, immediately that concept of pre-construction period interest should come to your mind. In this case, since the date of loan is 1st July 21 and the construction got completed in the next financial year, that is December 22, there will be some pre-construction period. Let us find out how much is that pre-construction period. Can I say pre-construction period starts from date of taking loan? There are some authors who are of the view that when the loan date and the construction date, they are different, then we should start the pre-construction period from the date of taking loan or date of starting construction, whichever is later. So, even if we follow that view here, anyways, date of loan is 1st July 21, whereas date of construction beginning is 1st June 21. So, anyways, whichever is later date is 1st July 21. So, in this case, friends, the PCP will start from 1st July 2021. Friends, pre-construction period ends on a day prior to first day of the financial year in which construction is completed. Since the construction is completed in December 22, can I say it is completed in financial year 22-23? So, what is the first day of that? 1st April 22. What is the day prior to that? 31st March 22. So, can I say in this case, there is a pre-construction period of 1st July 21 to 31st March 22, that is 9 months. Sir, even though April to December 22 was also an under construction period, but still, remember friends, the year in which construction gets completed, it doesn't matter on which date it gets completed. Since it gets completed in 22-23, sir, property has come into existence. If property has come into existence, chapter has come into existence, entire interest of 22-23 will be allowed in 22-23 itself. However, the interest up to 31st March 22, till that time there was no property into existence. So only this will be considered as pre-construction period, and only the interest for these 9 months will be considered as pre-construction period interest. So how will you calculate that PCPI? Sir, the loan amount is 25 lakhs into 10% into 9/12. So 187,500 will be the pre-construction period interest. So can I say that is it? There is no repayment of the loan. So now we can talk about the interest of SOP completely. If I write it here, this is LOP. Now interest of SOP. Now interest of SOP. One is current year interest. 23-24's interest, since the loan is not repaid till date. So even that 25 lakh into 10%, 2,50,000 is current year interest, na? Plus whatever is this PCPI that is allowed as a deduction in 5 equal annual installments starting from the year in which construction is completed. Since the construction is completed in the year 22-23, sir, in 22-23 you will get 1/5 of PCPI, 23-24, 24-25, 25-26 and 26-27. So in the 5 financial years, you can take 1/5 of PCPI as a deduction along with your current year interest of that year. So plus 37,500. So 2,87,500 is the total interest claim. This is 1/5 of PCPI. So 2,87,500 is the total interest claim for the SOP. Friends, when you calculate the interest, never start thinking whether it will be allowed or not. But once you have calculated the interest, now you start thinking whether this will be allowed or not. So the answer to that is, sir, what is the type of property? Can I say Delhi one is LOP? So sir, entire 420 allowed. And since Kanpur one is SOP, can I say, friends, for Kanpur property, maximum is 2 lakh or 30,000 based on those 4 conditions. Let us check, because it's a SOP. First condition, loan must be taken on or after 1st April 1999. Yes, sir, the loan is taken in 2021. Second condition, the loan must be taken for construction or acquisition. Yes, sir, the loan is taken for construction. Third condition, if the loan is taken for construction, then the construction must be completed within 5 years from the end of financial year in which loan is taken. Sir, loan was taken in July 21. The end of this financial year is March 22. 5 years to this ends on March 2027. My construction should have got completed on or before 31st March 27. Sir, it has got over in December 22 itself. So can I say even third condition is satisfied? The construction is completed within 5 years from the end of financial year in which loan is taken. Last condition, friends, we have always kept on saying even in our lectures, if the last condition question is silent, we can simply consider yes, interest certificate is received. So assuming that is interest certificate is received, maximum deduction for SOP will be restricted to 2 lakh. Now friends, if you do like this, you will get the incomes in this manner. Your income from house property from LOP of Delhi 1175 negative, that is a loss. Whereas from LOP, SOP will be 2 lakh negative. So if you go by this view, you will get a total loss of 2 lakh plus 301175, that is 501175. Now if you read the question further, friends, I hope income from house property calculation is clear. If you read the further question, they are saying Raj is just having one salary income of 18 lakh. Since they are again using the word earned, we'll consider it to be gross. So, since he is having income from salaries, which is 18 lakh minus 50,000, 17 lakh 50,000, and there is a loss from HP, which is 5 lakh 1175. Friends, if you remember, loss from house property can be adjusted inter-head in optional regime, since they are asking us to calculate the income under both the regimes. Under optional regime, loss from house property head can be adjusted against income from other sources. However, maximum inter-head is only 2 lakh. So therefore, this 5 lakh cannot be adjusted completely. It will be adjusted maximum 2 lakh. My net total income, first of all, my gross total income will be 15 lakh 50,000. Even if I go under default tax regime, as I said earlier, in default tax regime, income from salary will be still same because standard deduction of salary has got allowed now. And yes, first of all, since in this question there is no other information, we cannot find any deduction related information. There is one catch, but I will come to that later. But as such, apparently there is no other deduction related information available. So only this one deduction, standard deduction, I can take in default also. Friends, in default regime, my loss from house property will first of all reduce. Why? Because in default tax regime, interest on SOP 2 lakh will be gone. That won't be allowed. So only the loss of house property from LOP 3 lakh 1175, because in LOP there is no change even in default regime. So this will be my loss from house property in default tax regime. Friends, in default tax regime, if you remember, inter-head adjustment of house property loss even up to 2 lakh is not permitted. So in default tax regime, my GTI will become 1750 itself. And since, as I said, there is no other deduction information appearing apparently, net total income under both the regimes appears to be 1550 in the optional regime, 1750 in the default tax regime. I hope this much is first clear. Now friends, here there is a catch. Pay attention. Since for this let out property, Delhi property, look at the date of loan, which I told you to pay attention and mark at that time. Friends, in April 21, the loan was taken for Delhi house. Stamp duty value is given 40 lakh rupees. Pay attention, friends. If you recollect, there was a provision which was saying that if an individual is purchasing any house property for which he is taking a loan, and that loan is taken from a financial institution, that loan is taken from 1st April 2019 to 31st March 2022. It must be sanctioned between this period. And the assessee is not having any other house property on the date of such sanction of the loan. And he is also not eligible for 80EE deduction. And the stamp duty value of the house is less than equal to 45 lakhs. If you remember these conditions, which conditions I will just list down once again. Stamp duty value of the house less than equal to 45 lakhs. Loan sanctioned between 1st April 2019 to 31st March 2022. Similarly, no other house on date of sanction, not eligible for 80EE, which was again an exceptional section which came only for the loan sanctioned between 16-17, and loan taken from financial institution or housing finance companies. Friends, don't you think this fellow Raj, for his Delhi house property, is satisfying all these 5 conditions? Sir, how? Stamp duty value 40 lakhs, which is below 45 lakhs. First condition satisfied. Loan sanctioned between 1st April 2019 to 31st March 22, sanctioned in April 21. Satisfied. No other house on the date of sanction. Sir, he has Kanpur house. But look when the Kanpur house came into existence, December 22. So can I say on April 21, that is on the date of sanction of the loan, he was not having any other house? Satisfied. Not eligible for 80EE, yes, because in 16-17 he had not purchased any house by taking a loan. Loan taken from any bank or financial institutions, yes sir, SBI. So can I say, since all these conditions are satisfied, sir, what happens if all these conditions get satisfied? That fellow can claim 80EE deduction for interest on housing loan over and above section 24. Friends, since this section is an additional deduction which says over and above deduction can be taken of up to maximum 1,50,000 in a year, which will be over and above section 24. Generally, we check this section only for a SOP. In our question, the properties LOP, because for SOP Kanpur, this section is not applicable, because for Kanpur property, these conditions are not satisfied. Generally, we check this section for SOP. But in this question, since there is a LOP which is covered under this section is actually nowhere putting a condition that the property should not be LOP. We just generally say that since for LOP entire deduction is allowed under section 24, so section 24 only you should claim. You should not come for LOP in this section. But since there is no such restriction that the property should not be LOP in this section, and in our question there is a LOP which is coming under this section, let us do some evaluation. Friends, if you recollect, for LOP under optional regime, and SOP under optional regime, default answer will still remain same, because in default even 80EE will not be allowed. So default answer will be still same, 17,50,000, no other change, irrespective of how you try to take that interest. So default answer is still the same, 1750. But friends, optional regime, we can evaluate one possibility. Don't you think that salary income is anyways 17,50,000? Let me write the salary later on. That NAV for LOP was 169,750. So 169,750 was the NAV into 30%, 50,925 was the standard deduction. Friends, interest which was 4.2 lakh. Now instead of taking that entire 4.2 here, if I try to take 150 in 80AA, because 80AA will maximum allow 150, only the balance amount, if I try to take here 2,70,000, let me evaluate what is the situation coming in that case. And 2 lakh was the interest of SOP maximum. So friends, can I say in that case my LOP will have a loss of 151175, whereas SOP will have a loss of 2 lakh. So the combined loss will be 3,51,175. This will be my combined loss. Now if I try to evaluate my total income, my income from salary was 1750. Even now the deduction, that set off of loss from house property will be restricted to 2 lakh only, rest will be carried forward. So 15,50,000 will be my GTI. Friends, but now I can at least take 80AA, which is 150, because all those conditions are satisfied. So my net total income under optional regime will further reduce by 1,50,000, which will become 14 lakhs. So that's why if you look at the answer which is printed now, they have not given three answers. They have just given 2 answers. In the first one, they are simply saying that no deductions will be allowed. So anyway, 1750 will be the total income. In the second case, under optional regime, they are directly taking 2,70,000 only here. Rather than showing both those options which I have evaluated, they are directly saying 2,70,000 only here. In that case, my loss will be 351,175, which will restrict to 2 lakh. So GTI will be 1550, from which 80AA will be taken 1,50,000. So total income will become 14 lakh. However, just for the sake of evaluation, I told you that even if we take the entire deduction of interest under section 24 itself for LOP, then my loss will be 5,01,175, which is anyways of no use. I will be able to adjust only 2 lakh rupees. My taxable income will be 15,50,000. So I hope this much is clear. Yes, let's continue now. So we had seen till question number 10. Question number 10 was talking about Mr. Raj, wherein he was having 2 house properties. One was a self-occupied property, one was a let-out property. In this question, we had seen the adjustment of 80AA, which was available for a let-out property. Now let's proceed further. The next question, that is question number 11. Question number 11 says, let's read the question first. Mr. Rajkumar bought a residential house for 5 CR in March 2016, that is financial year 2015-16. He entered into an agreement for sale of the said residential house with Miss Nikita, not a relative, okay, in July 2023, that is financial year 23-24. So this is the date of, or you can say month of entering into agreement, for 17 crores. So that is the agreement value. The sale proceeds were to be paid in the following manner: 10% through account payee bank draft on the date of agreement. So 1.7 crores was to be paid by Nikita to Rajkumar at the time of making that agreement through a bank draft, account payee bank draft. 80% on the date of possession of the property. So whenever she will get the possession, Nikita, she will pay further 80% to Rajkumar. Balance after the completion of the registration of the title of the property. So balance 10% will be paid by Nikita to Rajkumar at the time of registration. Miss Nikita was handed over the possession of the property on 10th November 2023. So possession is being given on 10th November 23, and the registration process was completed on 5th Feb 2024. So friends, even the agreement is done in July 23, that is financial year 23-24, and even the registration got completed in the same year itself, 5th Feb 24. She paid the sale proceeds as per the sale agreement. So she would have given 80% in the month of November and balance 10% she would have given at the time of registration. Value of the property for stamp duty in July 2023 was 19 crores. So this is the stamp duty value on the date of agreement, that is 19 crores. Subsequently, the State Stamp Valuation Authority has revised the value. Hence, the value of property for stamp duty purposes was 20 crores on 5th Feb 2024. So this is the stamp duty value on the date of registration. So 19 crores is the stamp duty value on the date of agreement and 20 crores is the stamp duty value on the date of registration. Mr. Rajkumar paid 1% as brokerage on sale consideration received. So he has given 1% as brokerage, that is expenses in connection with transfer. Subsequent to sale, he purchased another residential house for 13 crores in Mumbai in March 2024. So in the next month itself, that is in March 24, he purchased another house, residential house, for 13 crores. You are required to compute the capital gains chargeable to tax in the hands of Mr. Rajkumar for the assessment year 24-25. So friends, we will have to calculate his capital gain income for financial year 23-24. What would be the capital gain, if any, in assessment year 25-26, that is the next financial year 24-25, if Mr. Rajkumar transfers the new residential house in December 24 for 15 crores. So basically they are saying this house which was purchased in March 24, if he is transferring that house in December 24 for 15 crores, then will there be any capital gain? So let us see this question, friends. In this question, first of all, let me tell you how many provisions are getting covered. First of all, this question is from income from capital gains chapter, wherein we will have to calculate the capital gain of Mr. Rajkumar on the capital asset, that is residential house. The transfer has happened in the financial year 2023-24. This house was acquired by him in the financial year 2015-16 and he has transferred it in the year 2023-24. They have given us the agreement value . They have given us the agreement value, that is 17 crores. They have given us stamp duty value on two different dates. Date of agreement 19 crores and date of registration 20 crores. There's a brokerage payment of 1%. Then they are talking about some new house property which is coming into picture and again that is getting sold. So anyways friends, these two parts are related to section 54. When Rajkumar has transferred one residential house and he has acquired another residential house, on the transfer of the first residential house, whatever capital gains he has earned, if that is long-term capital gains, then subject to reinvestment in a new residential house, he can take exemption under section 54. However, once he takes that exemption under section 54, then as per section 54, he is supposed to keep this new house property which he has acquired for at least 3 years from the date of purchase. That is the lock-in period. He has to keep that property for at least 3 years. Since he is transferring that property, can I say in the same year itself, that would amount to violation of that lock-in period. So this part is talking about the consequence on the violation of the lock-in period. So this answer is actually having three parts. One is computation of capital gains on the initial house. Secondly, taking exemption under section 54 in front of the capital gains of the initial house. And thirdly, calculating the consequence on the violation of the lock-in period for claiming that exemption 54 but not keeping that house for 3 years. So let us see. First, let us calculate the capital gains for the financial year 2023-24. So if you see the answer, first they have calculated the capital gains. Mr. Rajkumar, computation of capital gains. Previous year is 23-24. Assessment year is 24-25. We are just discussing this answer as it is already printed, so I am writing short forms, but avoid writing short forms in answer in exam. So previous year 23-24, assessment year 24-25. Now, since we start with the full value of consideration, first of all, yes, period of holding. We'll first mention what is the period of holding of that transferred capital asset. Friends, the period of holding of the transferred capital asset, it was acquired in financial year 15-16 and transferred in 23-24. So it is from financial year 15-16 to financial year 2023-24. Since the asset is building, for building period of holding of 24 months is to be checked. Since it is greater than 24 months, therefore it's a long-term capital asset. Full value of consideration. Friends, generally we take the full value of consideration as the sales consideration, which is generally the agreement value. But if you recollect that section 50C, it says when the agreement value is less than the stamp duty value, which in our case is, the agreement value is 17 crores, whereas the stamp duty value is 19 and 20 crores. So when the agreement value is less than the stamp duty value and the difference between the two is greater than 10% of the agreement value, if it is less than equal to 10% of agreement value, 50C is not applicable. But if the difference is greater than 10% of agreement value, then as per section 50C, full value of consideration, that is the sales consideration which we take for calculating capital gain, that gets replaced with the stamp duty value. However, if there are two different dates of agreement and registration, so basically if the date of agreement and date of registration are different and the stamp duty value on both these dates are different, the stamp duty value on the date of agreement and date of registration are different, in such a case, which stamp duty value should be taken into consideration for applying 50C? In that case, section 50C further says, if the date of agreement and the date of registration are different, in such case, we must ideally take the stamp duty value on the date of registration for calculating capital gain. That is in our case 20 CR. However, if whole or part of the consideration, so even if part is received, it's fine. If whole or even if part consideration is received on or before the date of agreement through account to pay check, account to pay demand draft, or electronic clearing system or any other prescribed modes, which is that debit card, credit card, NEFT, RTGS, etc. So if part or whole consideration is received on or before the date of agreement through these modes, then in such case we can take the stamp duty value on the date of agreement instead of registration. So in our case, since they are saying 10% of the amount, 10% was received through account to pay bank draft on the date of agreement. So even if on or before the date of agreement, it's fine. Since 10% doesn't matter, even if 1% would have received, doesn't matter, it's a part consideration. So 10% received through such date, on or before such date, through the specified modes, we can take the stamp duty value on the date of agreement. We can ignore this stamp duty value on the date of registration. So in that case, if the agreement value is 17 crores, since it is less than stamp duty value, that is 19 crores, and the difference between the two is 2 crores, which is greater than 10% of agreement value, that is 1.7 crores is the 10% of agreement value. So the difference is 2 crores more than 10%. Therefore, FVOC will get replaced with stamp duty value. So that will be 19 crores. You will have to write a clear explanation as they have written here in the suggested answer. I'm just discussing the question, so that's why I'm not writing the complete stuff. You can see here actual sales consideration is 17 crores. At the most, no need to write word to word, but in precise manner you will have to express everything. Value adopted by stamp valuation authorities, you can see they have taken 19 crores and they have given the justification where the actual sales consideration is less than the value adopted by the stamp valuation authority for the purpose of charging stamp duty, and such stamp duty value exceeds 110% of the actual sales consideration. Then the value adopted by the stamp valuation authority. See, when they say 110%, they are actually talking in totality terms. Whereas we are just saying difference. Difference is greater than 10% of agreement value. The value adopted by the stamp valuation authority shall be taken to be the full value of consideration as per section 50C. However, where the date of agreement is different from the date of registration, the stamp duty value on the date of agreement can be considered provided the whole or the part of consideration is received by way of account pay, check, demand draft or by way of ECS through bank account or through prescribed electronic modes on or before the date of agreement. In this case, since advance of 1.7 crores is received by account pay, bank draft, stamp duty value on the date of agreement can be adopted as the full value of consideration. Perfect. Gross sales consideration, basically full value of sales consideration. Stamp duty value on the date of agreement, since it exceeds 110% of the actual consideration, so that is 19 CR is the FVOC. From this, we subtract the expenses in connection with transfer. Friends, always remember, irrespective of the fact whether you are taking FVOC as agreement value or stamp duty value, brokerage, if any, is always a percentage of sales consideration. So when they are saying brokerage was paid, which was 1%, that 1% has to be applied on 17 CR only. See, doesn't matter, in this question they had clearly written also brokerage as percentage of sale consideration. Even if they don't say, even if they just say brokerage 1%, always remember broker has nothing to do with what is the stamp duty value. You will always deal with the broker on the sales consideration part. So 1% of 17 CR, so 0.17 crores. So when you will subtract this from 19, you will get 18.83 crores as the net sale consideration. Minus, since this property is long term, will subtract the indexed cost of acquisition, because assessee will get the benefit of indexation. But index cost of acquisition is always applied on cost of acquisition. Cost of acquisition in this case is given as 5 CR. So on this 5 CR, we'll apply indexation. They have given us the CII. 15-16 CI is 254, 23-24 is 348. So if 5 CR is 254, how much is 348? You will get 6.85. So 11.98 is the long-term capital gain. There is no cost of improvement appearing in the question. Now friends, since they were further saying that you are required to compute the capital gains, subsequent to the sale, he purchased another residential house for 13 CR. See, whenever individual or a Hindu undivided family transfer a long-term capital asset, which is a residential house property, and they reinvest into a new residential house property, exemption under section 54 gets triggered. Since in this question the assessee is individual, since he has transferred a long-term capital asset which is a residential house property, if it would have been a short-term capital gain, no section 54 benefit is allowed. But since it's a long-term capital asset and it's a residential house property, section 54 gets triggered. Now, since he has invested in a new residential house property, he'll get exemption under section 54 for that investment in new residential house property. He'll get the exemption under section 54 for investment in new residential house property. Now, if you recollect friends, earlier section 54 used to say sell a house, buy another, whatever is your capital gain, just reinvest, you will get complete exemption. But in 2020, they amended. They added that capital gain amount criteria, that if your capital gain is less than equal to 2 CR, you can do the investment in 2 residential houses. You have the option of 2. But if the capital gain is more than 2 CR, then you just have an option of 1 house. You must reinvest in a new residential house property which has to be in India. Now, since they are saying new house was purchased in Mumbai, so he has invested in a new residential house which is in India. And since his capital gain is more than 2 CR, he has to invest in only 1 house. He cannot invest in 2 houses. So, if in this question they would have said he purchased 2 houses, one worth 7 crores, one worth 6 crores, both in India, then we would have given him exemption of only 1 house which would have been of 7 crore, because that would have resulted in maximum benefit to him. But since it is only 1 house, reinvestment is only in 1 house, ideally this is eligible. Now again, before budget 23, there was no such restriction on the amount of investment. Like in this case only, if the long-term capital gain is 11.98 crores, even though assessee has to invest in 1 house, if he ends up investing entire capital gain in that 1 house, then entire exemption used to qualify. Like since he has invested entire 13 CR, he could have taken 11.98 CR exemption. But in budget 23, one more amendment has come, which says that if the investment in new residential house property is more than 10 CR, then for purpose of exemption under section 54, that investment will be maximum considered as 10 CR only. So in our case, since the value is 13 CR, sir, after budget 23 amendment, now we cannot allow him exemption of entire 11.98. We will have to restrict this investment value only to 10 CR. So therefore, out of this 11.98, only 10 CR will get exempted. Sir, what about his 3 crore worth investment? That won't be eligible for any exemption. So 1.98 CR capital gain will become taxable now. Earlier, this advantage was like this. Disadvantage was not there for the assessee, but now from budget 23 onwards, assessee will have to pay tax on at least some amount if his capital gain is more than 10 CR. So I hope this much part is clear, wherein we have calculated the capital gain of 1.98 CR. You can read the justification. Where the LTCG exceeds 2 CR, the capital gain arising on transfer of a long-term residential house property shall not be chargeable to tax to the extent such capital gain is invested in 1 residential house in India 1 year before or 2 years after the date of transfer. Friends, here time limit was not the concern, because anyways he invested in the next month itself. So it's fine. You have to consider the time limit from the date of transfer, registration. Registration date will be considered as the date of transfer. So that was in Feb only. So in the month of March itself he invested. So time limit is not the concern. However, if the cost of new residential house, this is the amendment now. However, if the cost of the new residential house exceeds 10 CR, the amount exceeding 10 CR would not be taken into for account for exemption. So therefore, this much will be taxable. Now friends, once he takes section 54 in 23-24, then section 54 says, sir, the property which you acquired in March 24, it will have a lock-in period of 3 years. This property should not be transferred up to March 27. But the question says, he transferred that property in the next month, same year itself, in the month of December 24. So, March 24 he had acquired in the same calendar year itself. In December 24 he transferred that house for 15 crores. So, now since he has violated the lock-in period, there will be consequence. And ultimately friends, since even this house was a residential house, a capital asset, capital gain will be triggered. Period of holding of this house will be from March 24 to December 24. Since it is less than 24 months, it's a short-term capital asset. The full value of consideration for this house is 15 crores. He transferred this house for 15 crores. Point is, and yes, there are no expenses appearing, so we can ignore. Point is, since it's a short-term capital asset, he can't take indexation benefit. Only cost of acquisition will be subtracted. And friends, since the cost of acquisition was 13 crores for this house. The original cost of acquisition was 13 crores. But against that 13 crores, he has taken a 10 crore exemption which he has violated. Section 54 says, if the lock-in period is violated, then whatever is the capital gain taken as exemption earlier, that will be subtracted from the cost of acquisition of that property while calculating the capital gains on such property. It will be subtracted, that exemption taken earlier will be subtracted from the cost of acquisition of the property while calculating capital gains on such property. So therefore, from this 13 crores we will subtract the exemption taken earlier, and the net cost which will remain only 3 crores, that will be subtracted friends. 12 crores will become taxable, short-term capital gain. There appears to be a printing mistake in the RTP wherein they have wrongly written as 15 minus 3 CR, 2 CR, it must be 12 CR. Since the residential house was not held for more than 24 months, it's a short-term capital gains. I hope this is clear. If anyone was wondering, sir, why this information was written in the question, not a relative, because I hope you remember the gift provision, friends. In the hands of Nikita also, there will be a consequence under chapter income from other source in the financial year 23-24. Since she is buying a property and the property is getting received by her for inadequate consideration, the agreement value is 17 CR whereas the stamp duty value is 19 CR. Even for other source chapter, we apply that logic. If the date of agreement and registration are different, then the stamp duty value on the date of agreement can be taken, subject to that part consideration getting paid. There we see getting paid because we are talking from the point of view of payer there, Nikita there. So if she has paid 10% part consideration on or before the date of agreement up to the through account pay, check, demand draft or ECS, in such case stamp duty value 19 CR will be considered for calculating her gift. So since 19 CR minus 17 CR is greater than, that difference 2 CR is greater than 10% of the agreement value, as well as that difference is also more than 50,000. So therefore that difference becomes taxable in the hands of Nikita as a gift, income from other sources. However, since that part is not asked in the question here, the answer is not printed. But in exam, even that part can be asked. So remember, since she is a non-relative, gift provision will get attracted. If she would have been a relative, she would have got that exemption. Gift from relatives are not taxable. Now the next question. Mr. Rajesh is a working partner in Sunflower Associates, a partnership firm. Rajesh has contributed 15 lakhs as capital in the firm. So this is his capital balance. Partnership deed authorizes the payment of interest to partners at 13%. Okay. And also payment of remuneration to partners 20,000 per month. Okay. Whole of the remuneration is allowable as a deduction to Sunflower Associates. Fine. Mr. Rajesh has set up a unit in SEZ in May 2017. The total turnover, export turnover, and the net profit for the year ended 31st March 24 were 120 lakh, 45 lakh and 7.5 lakh respectively. Out of the export turnover of 45 lakhs, only 40 lakhs had been received in convertible foreign exchange by 30th September 2024. During the previous year 23-24, Mr. Rajesh has commenced a business of warehousing facility for storage of edible oil. The net profit of the business as per profit and loss account is 7,50,000. The following items are debited to the P&L. Personal drawings are debited 70,000. Advance income tax paid is debited 1 lakh rupees. Purchase of warehouse building of 10 lakh rupees on 10th June 23 for the purpose of storage of edible oil. The following items are credited to profit and loss account. Interest on saving bank account with PO 15,000. Interest on fixed deposit with SBI 20,000. Dividend from Indian companies gross 32,000. He has paid the premium of 60,000 on life insurance policy in the name of his married daughter. The policy was taken on 1st October 2018 and the sum assured being 5 lakh rupees. Compute the total income and tax payable by Mr. Rajesh for the assessment year 24-25 under the default tax regime and under the normal provisions of the Act. So friends, they are asking you to compute the tax under 115 BAC also and under normal provisions also. Let us see. First of all, let us revisit the question and try to identify how many provisions are getting covered. Like when you start reading the question again, he is a working partner, capital is given, there is some interest received from the firm and salary received from the firm. Friends, both these incomes, interest and salary received from the firm will be taxable in the hands of Rajesh as profits and gains from business and profession. Salary from firm is not taxable as income from salary in the hands of partner because there is no employer-employee relationship. So it's a PGBP income. However, if you recollect section 40 clause B, section 40 clause B says that for the firm or the LLP, interest to partners on their capital and loan and the remuneration to partners by whatever name called will be subject to certain deduction for interest and remuneration to the firm or LLP will be subject to certain maximum limit. For interest, there is a maximum limit of 12%, whereas for salary, there is a maximum limit based on book profit. Since in this question, they have not given you the book profit and all that details of Sunflower Associates, you cannot find out how much would have been the maximum salary allowable to Sunflower Associates. However, remember friends that maximum salary which is allowable, that is always compared with the actual salary. And since the firm is paying 20,000 per month to Rajesh, so 2,40,000 is the actual salary. Whatever would have been the maximum salary based on the book profit calculation, maximum or actual whichever is less, would have been the allowed salary to him, to the firm, sorry. Now, whatever is the allowed salary to the firm as a deduction, that same amount becomes taxable in the hands of partner. Because an income for someone is an expenditure for another and vice versa. So if the firm gets a deduction of 240, partner will have to pay tax on 240. But if the firm would have got a deduction of only 2 lakh, partner would have paid tax on only 2 lakh. Now since the next line says, here only they are saying whole of remuneration is allowable as deduction to Sunflower Associates. It means this entire 240 would have been allowed as a deduction to that firm. Since this would have been allowed to the firm as a deduction, it means maximum salary as per book profit calculation would have come even more than that. So since entire 240 was allowed to the firm, entire 240 becomes taxable in the hands of Rajesh. However, interest, since firm has given 13% of 15 lakh, so 15 lakhs into 13%, 1,95,000, that won't be allowed to the firm as a deduction. It will be restricted to maximum 12%, which is 1,80,000. And since deduction to the firm is only 1,80,000, taxable in the hands of Rajesh will be only 180. Similarly, this part is talking about SEZ provision, so that 10AA deduction has to be thought about here. This part, apparently it looks like it is talking about 35AD, because the moment you read the words warehousing facility, 35AD starts coming to your mind. But friends, also focus warehousing facilities of edible oil. Edible oil is not an agricultural produce, manufactured product. So therefore, warehousing facility of non-agricultural produce is not a specified business. So 35AD is not there in this question. When they say interest on saving bank account in the question, section 10 clause 15 exemption should come to your mind. Interest on FD, but what is his age? The age is not given. In the absence of age, we always assume him to be non-senior, so no 80 TTV deduction. Dividend from Indian companies, fine. He has paid the premium of, so this is ATC, life insurance policy, premium of 60,000 on life insurance of married daughter. Friends, for section C, it doesn't matter whether the children are major, minor, married, unmarried, dependent, independent, it doesn't matter. For 80D, that matters. 80D says self and family will include only dependent children, but 80C doesn't say anything like this. So even if the life insurance policy is taken for married daughter, it's fine. What matters is he has paid the premium. The policy was taken on 1st October 2018, fine. So sum assured being 5 lakh. So since the policy is taken after 2013, I hope you recollect we had seen question number 1, case scenario, wherein I had told you those limits, that since the policy is taken after 1st April 2013, daughter is not said to be any disabled person or anyone suffering from those specified diseases. So premium should not have exceeded 10% of sum assured, that is 50,000. 5 lakh into 10%, but since it is 60, maximum deduction under ATC will be 50,000. So when they are saying compute the total income and tax payable of Rajesh under default tax regime, let us first focus on calculating his income under default tax regime, that is 115 BAC. Friends, total income always refers to net total income. Net total income is always gross total income minus deductions under chapter 6A to the extent they are allowed under default regime. And I told you yesterday itself that default tax regime allows 80 CCD subsection 2, 80 CCH subsection 2 and 80 JJAA. However, none of them are there in this question. So anyways, ignore. So in default tax regime, when we will calculate the income in this question, no deductions under those 3 sections will be allowed because they are not there in the question. So no chapter 6A deductions will be there in this question in default tax regime. So let us first calculate the gross total income. Gross total income is the total of all the 5 heads. Income from salary is not there in this question. As I said earlier, this remuneration from partnership firm is not an income from salary because there is no employer-employee relationship. Partners are not the servants of the firm, they are rather the owners of the firm. Employer-employee relationship refers to master-servant relationship. So therefore, it is income from business only. Even house property income is not there. So income from business, salary from partnership firm, friends, the salary 2,40,000, since that is completely allowed to the firm as a deduction, that entire 240 will be considered here. If they would have said that only 1,80,000 or only 2 lakh or any such figure was allowed to the firm as a deduction, then we would have considered only that much figure. But since they are not saying like this, we can consider that entire amount. And yes, no standard deduction has to be taken when the salary from firm gets taxed under PGBP head. No need to take any standard deduction 50,000. That standard deduction is under salaries head. Next is interest on partner's capital from firm. So that is 1,80,000. It was 195 received, but maximum will be restricted to 180 because only that much amount is allowed as a deduction to the firm. Friends, if only 180 is allowed as a deduction to firm is already paying tax on that 15,000. So why will Rajesh pay tax again? So he will not pay tax again. So these two are 4,20,000. So these are the incomes from that firm. Then there is further business income from this SCZ. So profit from SCZ unit. They are saying net profit is 7.5 lakh. Friends, under default tax regime, that 10AA deduction is not allowed. So when we will calculate his income out from in the default tax regime, no need to take deduction under section 10AA. During the previous year 23-24, Rajesh has commenced a business of warehousing facility. Okay, so profit from this warehouse. So actually for a student, default tax regime becomes very easy because all the deductions are to be ignored. Most of the deductions are to be ignored. The net profit of the P&L is 750. Friends, since they have given us the net profit directly, as this net profit is after debiting some items, crediting some items, we will have to follow indirect method to calculate the business income, wherein we will add back all those expenses which are debited but they are not allowed. Like friends, personal drawings. Drawings are not considered as a business expenditure, because if drawings are considered as business expenditure, then sir, your taxable business income will always be zero, because you will say I earn 10 lakh, I draw 10 lakh. So sorry sir, drawings are not considered as business expenditure. Similarly, advance income tax is paid. Income tax. Friends, advance tax or income tax, any provision for income tax, all these are again not allowed. Section 40 clause A, if you recollect subclauses of that section. So even this is not permitted. Advance tax 1 lakh rupees. Purchase of warehouse building of 10 lakh on 10th June 2023 for the purpose of storage of edible oil. Friends, if this business would have been purchase of storage of warehousing of agricultural produce, or it would have been warehousing of sugar, then section 35 AD says entire capital expenditure is allowed as a deduction. So if that would have been the case, he could have taken this deduction of entire 10 lakhs. But since his business is not a specified business, he should not have debited this entire capital expenditure. Since he has debited this entire capital expenditure, we will add back. Capital expenditure of warehouse building. So 10 lakhs will be added. So on that 750 we will add 10 plus 1 11 lakhs 70,000, and we will subtract incomes credited but not taxable under this head. So if you will see, he has credited interest on saving bank account with the post office 15,000. Sir, it's an income from other source. Remove this. And friends, while removing this from PGBP item, don't give effect to 10 clause 15. That will be given while calculating income from other source. So as of now, just remove this 15,000 which is credited to P&L. Interest on fixed deposits. $20,000. And dividend. Dividend is also income from other source. So 30, 40, 50, 60, 67 has to be removed. Also friends, don't you think when you disallowed this capital expenditure of warehouse building to him, you added that back? At least a depreciation must be allowed to him on that warehouse building. So you'll have to take the deduction for depreciation on the warehouse building. While taking the deduction for depreciation on warehouse building, you also focus on the date of purchase. Because if the date of purchase is after 4th October, then you would have taken only half depreciation on that. Because if the date of purchase and put to use is from 5th October onwards, the put to use would have been less than 180 days. However, since it is 10th June, considering put to use on the same date, depreciation will be entire 10%, full depreciation 10% of 10 lakh, that is 1 lakh rupees. So when you will do this add less, $17,53,000 becomes the business income. Now there are no capital gains, directly income from other sources. One is that interest on saving bank account. $15,000. But now you remember to take that exemption. Saving post office account, sorry, not bank account, savings PO account. Friends, against interest on savings post office account, there are two benefits. One is section 10 clause 15 exemption, which will be calculated while calculating the income itself. And once that income has become a part of income from other source, once it has become a part of gross total income, then even section 80 TTA deduction is entitled for that interest amount, because it's an interest ultimately from a savings account. So there are two advantages. First, we will take this 10 clause 15, and if you recollect section 10 clause 15, for an individual saving account, there is an exemption of 3,500 maximum. For a joint holder saving account, there is 7,000 exemption maximum. And this exemption under 10 clause 15 is only for post office saving account, not for a bank savings account. So in absence of information, we always consider the account to be individual holder account. 11,500 will become taxable. Then there is interest on FD, which was 20,000. And there is dividend. Dividend which is 32,000 gross. Friends, if they would have written the words net here instead of gross, then we would have considered that this figure is 90%. And then while calculating income from other source, we would have grossed it up. We would have considered that this is 90% after reduction of TDS. Because if you recollect section 194, it is on dividend from Indian companies, wherein 10% TDS is applicable. But since the question says the word gross, we'll ignore the TDS effect. Directly we'll take 32,000. So let's take the total of his incomes. PGBP income 420 plus 750 plus 1753 plus 63,500. So 29,86,500 is his gross total income. Minus deductions under chapter 6A. Since there is no AT-CCH subsection 2, since there is no AT-CCD subsection 2, since there is no AT-JJAA, all the three are 0. 29,86,500 will become the net total income under default tax regime. On this 29,86,500, we will calculate the tax as per default tax regime. Generally, we split the income into slab rate and special rate. But since in this question, there is no special rate income appearing, all these three incomes are slab rate income, slab rate income, slab rate income. So all entire it is slab rate income. So under default tax regime, those slabs of 3 lakh. So 29,86,500 minus 15 lakh on 14,86,500, 30%. $445,950. So 5,95,950. This is the basic tax. You don't have to show actually this calculation. See why even ICI shows in the suggested answer, so that students understand. But even though in exam you don't show that breakup, it's fine. You can directly write 595,950 by doing the calculation on your calculator. Basic tax. Will surcharge be applicable? No. For an individual, surcharge is applicable above 50 lakh. The total income is only 29 lakh here. Will rebate be applicable? No. Rebate is applicable only if the total income is less than equal to 7 lakh. So no surcharge, no rebate. However, health and education says 4% that will be applicable. Now, since this is the total tax payable, now since he has already paid some advance tax you would have noticed that in the question, while calculating that PGBP income, there was an advance tax paid of 1 lakh rupees. We can subtract that. And ideally, friends, on this there won't be any TDS, this there won't be any TDS, even this there won't be any TDS, because he is doing a warehousing business. Interest on saving account, there is no TDS. Interest on FD, there is section 194A, but if you recollect, there was a threshold of 40,000 for non-senior citizens. If the interest paid by a bank is less than equal to 40,000 to a non-senior citizen, 50 for a resident senior citizen, TDS is not deducted. So this amount would have been without TDS. Dividend, there was a threshold of only 5,000. So if this dividend from Indian company, if any of the Indian company has paid him a dividend of more than 5,000, then actually TDS would have come. But in absence of any information, we can assume this, that none of the companies have paid him more than 5,000 dividend, because this 32 not necessarily will be from one company. Question is using the word Indian companies. So it is safe to assume that no company would have paid him more than 5,000 dividend. So no TDS would have got deducted. So 5,19,788, which we will round off. This is the balance tax payable. 519,790. Since the last digit is 8, we will do upward rounding off. I hope this calculation is clear. Now this was as per 115 BAC, friends. In computation of total income and tax liability, as per optional regime, since they are also talking about optional regime, friends, in optional regime now there is no need to make the entire table. You can simply say total income as per default, that is 29,86,500, and you will have to just subtract the deductions or exemptions which are allowed under optional regime, which were not allowed in default. So you'll just have to glance through the information that was there any deduction you ignored in default. Here there is no deduction. Yes, 10AA we ignored. So let us take 10AA, because 10AA will be allowed when he is going under optional regime. Now friends, section 10AA, which is a tax holiday section for the units set up in SEZ, it says that if the unit is set up in SEZ from the previous year 2005-06 to 2019-20, which was further extended till 2021. So if the unit is set up in SEZ within this time frame, then a tax holiday of 15 years is allowed. Tax holiday of 15 years means for the first 5 years of the operation, that unit will get a deduction of 100% of export profit. For the next 5 years, it will get a deduction of 50% of export profit, and for the last 5 years, they will get 50% deduction of export profit, but subject to certain condition, and that condition is of reinvestment in SEZ. Now in our case, he has set up that unit in SEZ in 2017. So 17, 18, 18, 19, 19, 20, 20, 21, 21, 22, 22, 23 and 23, 24. We are currently into the 7th year. So since we are into the 7th year of business, the deduction is 50% of export profit. Now, how do you calculate the export profit for that purpose? First of all, friends, export profit will be calculated by doing a simple cross multiplication. Since total turnover is 120 lakh, on which a profit of 7.5 lakh is made. So on export turnover, that is 45 lakhs. How much? Now wait. Earlier you used to do like this, but now again here there is a small amendment which says that, sir, if that export turnover is not received in convertible foreign exchange up to 30th September of the assessment year, for previous year 23-24, assessment year is 24-25. So 30th September of assessment year means 30th September 24. So if any portion of this export profit is not received up to 30th September, then that much deduction will be lost. Like we will reduce that much turnover then. So since they are saying in the next line only 40 lakhs have been received in convertible foreign exchange, will not take this 45, will restrict it to 40 lakhs. So friends, export profit will be 2,50,000 only, and the deduction which is 50% of that will be 1,25,000. So again remember this small change now friends. The export profit, for calculation of export profit, we used to do the simple cross multiplication, total turnover, total profit, so export turnover how much. But now while calculating that export profit, we also have to take into consideration, while checking that export turnover, while taking that export turnover, only the turnover received on or up to 30th September of the assessment year in convertible foreign exchange will qualify for deduction. Next is friends, so once again let us glance through the question. Here there was one deduction pending, 10AA we took under optional regime. PGBP income no change. Income from other sources, interest from saving account no change. And yes friends, first of all I hope you observed section 10 clause 15 was still taken under default regime. Yes, because section 10 clause 15 exemption is allowed even under default tax regime. So anyways, that is okay. Interest on FD, dividend, fine. So gross total income is done. Deductions under chapter 6A, yes, deductions under chapter 6A, 80C we ignored at that time. So we'll take deduction under chapter 6A, that is 80C. Friends, 80C deduction is applicable for this premium paid for life insurance of his married daughter. So as I said earlier, since the policy is taken after 1st April 2013, maximum premium should not have exceeded 10% of sum assured. As it is exceeding 10% of sum assured, we will restrict it to 10% of sum assured. So 10% of 5 lakh will be 50,000. ATD is not there. Directly we have 80 TTA on this interest on saving account. Now interest on saving account is actual interest or maximum 10,000, whichever is less. Now since the actual interest itself included in the GTI is 11,500, now you don't say 15,000 or 10,000 whichever is less. Now you will say 11,500 or 10,000 whichever is less. So that is 10,000. So friends, 29,86,500 minus 1,25,000 minus 50,000 minus 10,000. So under optional tax regime, his income will be 28,01,500. This is the net total income. On this net total income, now you will calculate the basic tax as per optional regime slabs. In absence of information of age, always assume non-senior. So first 2,50,000 0, next 2,50,000. It is 5%, 12,500. Next 5 lakh rupees, 20%, 1 lakh. So on remaining 18 lakh 1,500. 30%. 544.50, 1 lakh plus 12,500. 650 to 950. Okay. And no surcharge, no rebate, but H&EC 4% will come. $650 to $950 into 4%, 26,118. Sorry. Okay, so 679,068. This is the total tax liability. But from this, you will get the deduction for that advance tax. So 579,068. This is the balance tax liability. And this has to be rounded off in multiples of rupees 10. So 579,070. That is the total tax payable, balance tax payable. Clear? Now here there are chances of one thing which students may forget, friends. Under optional tax regime, if the assessee is taking any deductions under 10AA, 35 AD, 80 QQB, 80 RRB and 80 JJAA, there is a concept applicable AMT. Friends, in this question, don't you think when you are taking this deduction under 10AA for the optional tax regime, that AMT concept is not applicable under default tax regime, because anyways in default tax regime these sections are not allowed, except 80 JJAA that is allowed, but that doesn't create any difference. But if you are going under default tax regime, AMT is not applicable. Friends, however, under optional tax regime, when you are taking this 10AA, don't you think AMT will become applicable? So this was the total income as per regular provisions now. Now you will have to calculate the adjusted total income as per AMT provisions. And adjusted total income as per AMT provisions is nothing but total income as per regular provisions, 28,01500, plus any of these deductions which are taken. So only 10AA is taken, 1,25,000. So friends, ultimately, can I say this becomes the adjusted total income as per AMT provisions, on which AMT will be applicable? So basic tax as per AMT provisions, that is 18.5%. $541,403. Surcharge and rebate even not applicable now, but H&EC will be applicable. Which will be rounded off to 463,060. And friends, since the tax liability as per the regular provisions is higher than the tax liability as per the AMT provisions, he will have to pay the tax as per the regular provisions only, because whichever is higher. I hope clear. So anyways, there is no concept of AMT credit then. If AMT would have become higher and he would have paid AMT, then he would have got that AMT credit. And since the question is actually not asking our advice that whether he should go under default regime or whether he should go under optional tax regime, we will not comment on that. But if they would have asked our advice, then actually which one is better you can see. In default regime, his total tax liability, balance tax liability comes 519,790. Whereas here it comes 579,090. 070. So 519 or 579. Sir, obviously default tax regime is better for him. Clear? Now the last question, friends, which is generally a theory based question. Mr. Rahul, an Indian citizen residing in Mumbai, files his return of income every year on time. He has Aadhaar number as well. He has not intimated his Aadhaar number to the prescribed authority till August 23. He approached you on 1st September 23 and asked you the consequences for not doing so and the effective date from which those consequences would be effective. What would be your answer if Rahul wants to intimate his Aadhaar number to the prescribed authority now? So friends, basically this question is from return of income chapter. In return of income chapter, if you recollect the provision with relation to Aadhaar, friends, this is a complete theory based question, so you'll have to write this answer in the theory manner only, the way it is written in your text, in your suggested answer here. But anyways, you can keep the language simple. Like first of all, you will have to remember the provision with respect to Aadhaar intimation. You must be remembering that every person who was having Aadhaar number which got issued after they were having PAN. See, if you have applied your PAN after getting Aadhaar, then your PAN which got issued by Income Tax Department is by default linked with Aadhaar and then got issued. But all those people who were already having PAN cards and then they had later applied for Aadhaar. So people who had already having PAN and then they applied for Aadhaar, they were supposed to link their PAN with Aadhaar. And for this linking, government had given a deadline of 31st March 2022, which was anyways extended, but that extension was subject to payment of late fee. But for free linking, the time limit ended on 31st March 22. So first you will have to mention that fact only, where a person who has been allotted PAN and is required to intimate his Aadhaar number has failed to intimate the same on or before 31st March 22. Ideally, the PAN of that person would become inoperative. But this will not immediately happen after 31st March 22. Even after 31st March 22, government did not immediately made it inoperative. They gave some extension of the time, which was till 31st March 23. But out of this 1 year window, first 3 months, that is up to 30th June 22, the linkage was allowed on payment of a fees of 500 rupees under section 234H. However, after 30th June, that is from 1st July onwards till 31st March, the linkage was allowed after a payment of 1000 rupees late fee under section 234H. And even this time limit of 31st March was further extended till 30th June 23, subject to that same payment of 1000 rupee late fee. Friends, anybody who forgot to intimate the Aadhaar to the PAN authorities, Income Tax Department authorities up to this date, so basically anybody who failed to link the PAN with Aadhaar even up to this date, their PAN cards were immediately made inoperative from 1st July 23 onwards. Now, surprisingly in the answer, Institute is not mentioning the facts about this one, that there was a 3 months extension subject to payment of 500 rupee late fee and subject to 1000 rupee late fee, there was further time allowed till 30th June. So that part they have not written. Anyways, you can write in your answer if you want. From 1st July 23. So in our question, they are saying he forgot to intimate the PAN to Aadhaar to PAN authorities. So further he is saying till August 23. So July 23 is passed. So you'll have to mention in your answer that from 1st July 23 his PAN card has become inoperative. And since on 1st September he is approaching us, we will intimate him the consequences. Friends, once the PAN card becomes inoperative, there are consequences like any refund for any amount of tax or part thereof which was due under the provisions of Income Tax Act shall not be made. Like if he had filed the return for the year 22-23 and that return was having a refund, let's say 2 lakh rupees, and he was going to get that money, but on 1st July his PAN card became inoperative. Government will not issue this refund now. Similarly, interest shall not be payable on such refund for the period beginning with the date specified and ending with the date on which it becomes inoperative. So since government had made that inoperative effect from 1st April 2022, because as I said, the free linkage was only up to 31st March 22. So from 1st April 22 till 30th June 23, if he was entitled for any interest on that refund, even that won't be allowed to him. Where such tax is deductible under chapter 17B in case of such person, such tax shall be deducted at a higher rate in accordance with provisions of section 206AA. Friends, I hope you recollect 206AA, which is there in TDS chapter. If payer is supposed to deduct the TDS of the payee, he is supposed to take the PAN card of the payee. If the payee doesn't give the PAN, or he gives invalid PAN, or he gives inoperative PAN, incorrect PAN, then in such case TDS is deducted at the rate applicable or 20%, whichever is higher. So now if your PAN card itself gets inoperative, then even if it was a valid PAN, even if it was a correct PAN, and even if the payee is giving that PAN, but since it has become inoperative, TDS will get deducted at 20% then. And lastly, where the TCS is collectible at source under chapter 17BB in case of such person, such tax shall be collected at a higher rate under the provisions of 206CC. I hope you recollect 206CC also. Friends, in 206CC, they were saying if the if the collector is supposed to collect TCS of collectee, he is supposed to take the PAN of the collectee. If the collectee doesn't give his PAN, or he gives invalid PAN, or he gives incorrect PAN, in such case, TCS shall be collected by the collector at twice of the actual rate or 5%, whichever is higher. So in such case, even if he is giving the PAN, even if he is giving correct PAN, even if he is giving a valid PAN, but since it has become inoperative, TCS will get collected at a higher rate, which will be 5% then. These consequences will become effective from 1st July 23. Now further they are saying that Mr. Rahul wants to intimate his Aadhaar number now. So can he do so? Yes, friends. See, just because on 1st July they have made your PAN card inoperative doesn't mean that there is no going back now. Yes, you can still get your PAN operative once again, provided for that first you will have to pay that fee of 1000 to government. Once you pay that prescribed fee of 1000 to government under section 234H, your PAN will become operative within 30 days from the date of intimation of Aadhaar number. Like the moment you pay that fee, you will have to simply do a small procedural formality of linking that PAN with Aadhaar. Once you do that, then within 30 days of that intimation, your PAN again becomes operative and you will not be liable for the above consequences from such date onwards. I hope it is clear. So that's all in the RTP, friends. In my personal opinion, the RTP of May 24 attempt was not having very difficult level of adjustments. In my personal view, it is very simple RTP this time. Rather, the previous RTPs were having still very tricky adjustments in my personal opinion. The only few observations which I would again like to summarize. First observation is that life insurance policy amendment which they included in this first question. So I would suggest students to read that amendment very nicely and go, because anyways in your statutory update PDF they have given n number of examples on that amendment. So please go through all those examples very nicely and go. Secondly, in my view, this clause H of section 43B, which is anyways becoming a very big trouble for all these traders, sorry, not all the traders, for all these micro and small enterprises, people who are dealing with micro and small enterprises. Yes, one point, just because I said that trader word, this provision is not applicable if that micro or small enterprise is a trading enterprise. This provision is not applicable. This is only applicable to manufacturing and service sector entities. For trading entities, this provision is not applicable. When I say trading entities, the entity to whom you have to pay, that should not be a trader. You are a trader, that doesn't matter. Okay. So clause H, that becomes very important now. And one more thing, friends, yesterday while discussing this question, I did not discuss the criteria of when an enterprise is micro and when an enterprise is small. Ideally, there are turnover limits and investment limits, which you can see, it must be there in your statutory update PDF. Or even if it is not there, it can be seen from that BOS knowledge portal. You can see that much stuff from your statutory update, not statutory update PDF, from your revised module. You will get the criterias of when an enterprise is micro and small. Those criterias need not be mugged up, because anyways in your question answers, they won't test you on when an enterprise is micro or when an enterprise is small. They will directly give you, unless they want to draft a very difficult question, in which case those criterias will also become very important. So just remember those criterias also very well. Then next was this 206C subsection 1G amendment. Those rates which are changing from 1st October 23, that one is covered in this question. Deemed residency got covered in this question. Generally, ICI had not asked very quality questions till now on deemed residency, but this was still a good question. Then this one was having 80EE adjustment, which students will tend to forget generally, because generally people are of the view that 80EE can be taken only for self-occupied property. And it is not wrong also, friends. Generally we take it for self-occupied properties only, because for let-out property entire deduction gets allowed under section 24 itself. But sometimes when your losses are huge from house property, such that the loss is getting restricted to maximum 2 lakh, in such case you can evaluate that whether I should take the entire deduction under section 24, or I should take the deduction which is allowable under 80EE, and then only the remaining I should take under section 24. Then you can evaluate in that manner. Similarly, this question was having in that amendment of section 5410 CR. So basically I find this RTP majorly focusing on the amendments. Otherwise, all the old provisions, not very quality adjustments are there in this RTP. In this question, anyways, yes, this one amendment which came in that 10AA regarding that amount to be received in convertible foreign exchange up to 30th September. And this was on that constant issue of PAN-Aadhaar linking, consequences for not linking it. Fine. So with this, friends, I would end this discussion of RTP here. Best of luck for your examination. Do well. Thank you very much. All the best.